The slowdown is here, and it will continue. We still have the worst ahead of us.
We can actually see inflation moderate without going into a recession.
By the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
You have to have a little bit of humility when you look at these forecasts.
The market is volatile right now because nobody really knows what to do or what to expect.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Slow news day in financial markets. David Solomon to the FT. It's clear that my DJing had become a distraction. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market TK slightly negative on the S&P 500.
Slightly negative there, and a disinflationary trend in order. Yields come in. Did you see yields yesterday? I was taking a surveillance nap.
Sure, yeah.
I woke up to lower yields.
Mid-single-digit move.
What I'm focused on nationwide is housing and how it folds in with housing data today. I think, we're all laid up here for sort of a lazy path into December, and I got my radar up.
Cumulative inflation.
Cumulative.
That's what you're focused on, and you're right to be. Reed Pickett at Bloomberg News did a fantastic job of putting out this article in the last couple of days. It's hard to find an area of household budget that's been spared. Groceries are up 25% since January 2020. Same with electricity. Used car prices have climbed 35%, Tom. Auto insurance up 33%. Rents, to your point, roughly 20%. That's the reality that a lot of Americans are living right now.
The pushback on it is that, there's rising wages, there's this, that, and the other thing. And I just think the public doesn't buy it. The public's saying, we don't feel those rising wages. But I'm focused on rents and multifamily folded into today's economic data, and then how that frankly follows over even into the stock market.
Lisa, that cumulative inflation of the last 3 years is why so many people, poll after poll, indicating they don't feel good about this economy.
It's true. Even if their wages went up almost the same amount, it doesn't matter, because what research has shown is that the prices that you pay are much stickier in your mind than the amount that you're earning, especially because people don't deposit checks anymore. So they just sort of get it direct to deposit their pay. And so they might not see the same kind of wage inflation in real time. I'm just saying theoretically. But the other thing I have to say is you really, it is a slow news day. So you really wanted to talk about the DJing, but you kind of wanted to slip that in so it didn't lead the show. But I think that really is interesting.
Well, it kind of did lead the show.
You did lead the show.
Comments in an FT conference. Didn't Goldman try and push back against that and say it wasn't a distraction? Now David Solomon's basically saying it had become a distraction.
Exactly.
But a media distraction. Is that how they'd like to frame it?
Not a distraction from his personal focus on the company, but it just shows where we're at in terms of the news flow that we're focusing on.
It's a fragile time it's a fragile time for executives, and frankly for those who are receiving bonuses. We're into the year-end season. How do we adjust? How do we recalibrate into next year? And I would go as much as the Barclay news of a troubled bank really trying to figure out what the path forward is. We don't talk that much about Barclays, London-based, but the answer is all the banks in some way are doing a Barclays. They're saying, what is the future?
A big conversation about this morning over in London. Manus Crony, Danny Berger talking about it in Bloomberg Brief. There's a report in the Financial Times indicating that maybe they could be cutting a lot of clients to save costs.
Yeah, just anything goes, and this really sets up. We're going to be at Apollo next week. John's arranged us. What are we doing at Apollo?
We're catching up with
Showing
Mark
up
Rowan.
for coffee, Danish.
Gives out to Torsten Slot. Great lineup. Jay Clayton, remember Jay Clayton?
Yeah, but this is important because they're in the nexus of this debate about what the future is, Wall Street, or is it private industry, private equity, private finance?
This will excite you. Fed speaks back today. Lisa can go through some of the names, Tom, but it really climaxes with Chair Powell on Friday.
Yeah, well, the Fed speak, I'm going to go to Powell, but what are we going to hear, John? What I'm seeing is what David Rosenberg's talking about is look at the housing data yesterday. And here's the key thing, John. It moved the market. A lot of these stories, these narratives right now aren't moving the market. The stock market's basically half asleep after a big rush. I get it.
Apparently we might be too. So let's turn to the scores.
I just, I think the housing data is
100%.
I just think the housing data is a big deal.
All right, we'll get to that housing data later. Here are the scores. Equity futures slightly negative on the S&P 500. We need to talk about spending, holiday spending, Black Friday, tremendous, Cyber Monday. All indications based on forecasts, Lisa, much better. And the TSA, record travel over the Thanksgiving holiday, back to a record. America is getting back to it.
Isn't it nice?
It's beautiful. I love it.
I think it's really nice. It is great. It's sort of curious, though, how they're paying for it. We could talk about leverage ticking up with buy now, pay later. But before we get there, Tom, you're focused on housing prices, and that actually is a good place to focus. We're going to get the CoreLogic Case-Shiller 20-city home price index data at 9 a.m. We're also getting some other price indications. Yesterday, new home sales came out much below people had expected, but the median price of those home sales has fallen 18% year over year, which a lot of people focused on. Key question, and we might be able to answer this a bit today, is this just builders discounting existing homes that they've built to clear inventory, or is this a market decline in prices for houses? I'm really curious about that. 10 a.m., the Fed speak commences. Chicago Fed President Austin Goolsbee, Fed Governor Chris Waller, both speaking at separate events. Later in the day, we hear from Michelle Bowman and Michael Barr and Goolsbee again. And that's just today. Yes,
auction update?
Oh, that's funny that you mentioned at 1 p.m.
Oh,
Thanks. U.S. Treasury is planning to sell $39 billion of 7-year notes. You said you took a nap. You woke up. Yields had cratered. Well, it was because the
oh, come on. It wasn't the auction.
It was sure. It was partly because the auctions actually came out pretty well.
To negative 18% on housing, which is a stunning number. I think it even leaps past 2008. The 30-year mortgage, John, it's cratered down from 8.03 to 7.81%. That explains a little.
There was some really good news. When was the last time you read a story about Sam Altman and OpenAI? It's about a week, hasn't it?
It has. It fell off the radar completely.
Thank goodness for that. John Stolfus joins us now, Chief Investment Strategist at Oppenheimer Asset Management. John, it's great to catch up with you, sir. We haven't got a price target yet from you for year-end next year. I know you're going to be putting that out in the next couple of weeks. One thing you are looking for, though, is this rally to continue. And, John, what I think is interesting about your call is this is not a rate cut call from you and the team. You're not looking for rate cuts until the back end, potentially, of next year. What is this call, John, this bullish, constructive view based on?
Well, it's based on a lot of things, Jonathan. Thanks for having me on the show. Always great to be on surveillance on Bloomberg. The big story here really is it's technology is really changing the way we live. We all know that, but we get kind of jaded about it. But the whole concept of the investment that's going into AI, the efficiencies that already AI as it exists create for profitability for companies, even in tough times, and the changes it can make for both that are positive for both the consumer and business, as well as the questions, as to what's negative about it, all overall says stock prices to move higher as technology feeds all 11 sectors or all the other 10 sectors or all the other 9, because 2 are predominantly tech, communication services, and infotech.
John, you absolutely nailed the year-end bull market rally. I can remember back in the summer, you were a piñata. Why hasn't the market moved? And boom, here we are with a Stolfus bull market. Is it a bull market? And will all that cash, in your study of history, will a part of all that cash buildup we have, will that move into stocks?
I believe it will, Tom, and there are several things that are involved. You've got the baby boomer generation has already begun to retire for quite a while, but there's still a lot coming. And the problem for boomers is they may live longer than they ever would have expected when they first opened up their IRA or their Keogh plan, what have you. And so in retirement, people are going to need to own equities. Interest rates, well, we've got yields that are much more attractive than they were before. Net after taxes don't look all that good based on where inflation is today. And even if it goes to 2%, a 5% yield doesn't turn into all that much attraction. And owning good businesses is historically, past performance, no guarantee of future results. But owning good businesses that are well managed tends to be a good way to invest for the intermediate to long term. So we think that's good for equities. This looks like the best opportunity here, not at this moment necessarily, but generally speaking, at this period in time on the timeline, this looks like a great time for investors in equities, and a good time when all of a sudden bond issuers have to pay for the privilege of borrowing money so you can diversify.
John, it strikes me that this doesn't sound like a late cycle market. Do you think that we're actually mid-cycle?
I think, gosh, you just hit it. I was just going to say, I think the mid-cycle is as wide as the Amazon. No reference to the company by that name, but the river, the Amazon. And we've thought that since Ben Bernanke got changed the way the Fed operates. It causes the end cycle has been very distorted by the changes that the Fed has made in communication and transparency and in sensitivity to as how its mandate affects the economy, both the consumer and business. And we think it's a very positive change. The imperative is that the personality of the Fed chair be attuned to the Bernanke legacy, and we think Powell is attuned to it.
I was struck by the sort of mid-cycle call because you like cyclicals and you like financials at a time where we see them looking at ways to cut costs. Why are you bullish on financials, given everything that we've seen and capital markets being as slow as they are?
Well, I think that the looking at costs, I think that's a positive thing. We saw when technology looked at costs, we saw one of the biggest technology names go from down 70% to all of a sudden a huge rally. And we think that related to banks may not do that, but related to banks, right, they are in a good position to fund what's coming forward.
John, as the world awaits your 2024 bull market call, what is the attribute that's the greatest mystery? Is it some CFA ratio, say enterprise value to EBITDA? Is it something the Fed's doing? What's the thing that determines whether you're going to be at 6,000 or 5,800?
I think a lot of it has to do, Tom, ironically, the markets are very much like music. They are a combination of mathematics and emotion. If you look at a piece of sheet music, it's highly mathematical. But what brings it to life is the interpretation by the musician. And I think we have to watch, beware of darkness, the projection of on any given day. Anything that looks negative, the bear camp can take and project negatively into the future to the nth degree. And we have to watch for that because markets have good days and bad days, but the overall trend looks like, because of the rate of innovation that we have and its positive effects on the consumer and business, we think that there's more upside than downside. So we'd say beware of darkness. So we quote, I think, George Harrison.
Lisa feels seen.
I
John
do.
Stolfus of
100%.
Oppenheimer Asset Management. Just had you at the corner of my eye, Bramo. Just feeling quite seen as he goes through that. Beware of darkness.
I feel
going
like
into
he's seeing into
2024.
my soul. Well, no, I mean, it's sort of, the fact that he's saying, look, it's not going to be a straight line up. It's going to be choppy. There are going to be moments of angst. There are going to be moments
There always are.
Yes, it's true.
Hey, John, thank you. Let's catch up before year end when we finally get that price target. I imagine that price target, Tom, is higher than where we are right now.
I did okay. I tried to get in 6,000 so he'd comment, but he wouldn't.
Look, Binky's at 5,100 over at Deutsche Bank. Sounds like John's going to be in that kind of range, right?
Absolutely.
Going
this
into
goes
next
back
year.
to Gina Martin Adams, Bikram Chadha, John Stolfus. You can't participate in the American investment and economic experience unless you play. And if you're on the sidelines, whether it's 5% cash or whatever, you don't get to play. That's their core thesis.
And then you miss big days.
You miss
massive months, like the month of November. Got some constructive news for you late yesterday. Allow me to get you up to speed on that. On Israel. Israel and Hamas have extended their truce late yesterday after agreeing a release of more hostages and prisoners. And Washington, development there as well. Secretary Blinken visiting Israel for the third time since the attack, Tom, back on October 7th.
It's the ballet. I've been watching it carefully. What's interesting is there's so much coverage. I don't read the articles, but I just gaze the headlines and the tone. And it's a very constructive tone. And my answer, Lisa, is what we talked about yesterday with our really qualified guests, Aaron David Miller particularly. How does the military of Israel respond to this blanket hostage coverage? I just don't know.
We don't know.
It's original.
I mean, everyone's resetting, and that's sort of a question of resetting for what?
We'll reset that conversation coming up next with Norman Rule. Look out for that. A little bit later this morning, 7:45 Eastern Time, former New York Fed President and Bloomberg opinion columnist Bill Dudley on the Fed Speak. The Fed Speak resumes a little bit later on. From New York City this morning, good morning.
You have to expect a group like Hamas, a terrorist group, which clearly doesn't abide by laws of war, will try to take advantage of any pause in the fighting for their own benefit. So we're watching that closely, as well as our Israeli counterparts. You can bet that they're watching that closely. And as you've also heard the Israelis say, that once the pauses are over, they intend to go right back at military operations.
That was National Security Council spokesman John Kirby addressing the press as Israel and Hamas extend a temporary truce, entering a fifth day this morning. Live from New York City, good morning. Your equity market looks like this on the S&P 500. Equity futures pulling back by almost 1/10% on the S&P, snapping a two-day winning streak on the S&P 500 with a small day of declines. Yields a little bit higher by a basis point, 439.82. Lisa went through all the Fed speak you'll get a little bit later. But America getting back to it, Tom. We've got a record at the TSA, record travel over the weekend. I think a record going back to 2019. We've surpassed that now.
I would suggest
Black Friday strong, Cyber Monday strong, surprising to the upside.
I'm going to go to Ben Laidler and his great Christmas Eve bull market call X number of years ago. What we've seen in the arc of the pandemic, into the pandemic, in the pandemic, after the pandemic, is just the incredible resiliency of the American consumer. We can go this, stimulus, ... You know what? Everybody got this wrong.
And can we extend this cycle?
Yeah.
Wells Fargo out with their outlook, suggesting, Tom, Chris Harvey and the team, that good news might be, do you want to say it?
Yeah, sure, bad news.
Bad news. Good news might be bad news.
Thank you. That's the bad news side of the table. I'm listening to John Stolfus and other bulls. I got the hate mail I'm getting from the Bears is unbelievable. They're just like
from me.
You know,
just Lisa picking your messages across.
Lisa emailed me again, but you know,
so
it's that time of year. Liz Ann Saunders came out
Stolfus
with
say, beware the darkness.
Yes, beware the darkness. There will be periods of darkness.
Beware of the darkness.
Joseph Conrad's joining us in the next hour. Joseph Conrad will join us. We take immense pride, and I'm talking for the wonderful team we have working 24/7 of giving you people of experience as we look at the horrific war in the Eastern Mediterranean. We've been advantaged by Norman Roll to say he's a former senior U.S. intelligence official at the Center for Strategic and International Studies, barely describes his public service to the nation. Mr. Roll, I want to cut to the chase here. My amateur reading of fiction is that a ceasefire is an intelligence opportunity. Is this ceasefire good for the Israelis to develop intelligence in Gaza?
Good morning, and you are absolutely correct. Keep in mind that the Israelis have a variety of means of intelligence they must ingest at present. Prisoner interrogations take quite a while. Laptops have thousands of pages of data that must be reviewed, and you're looking to identify locations of individuals, hiding sites, weapons capacities, movement profiles, so that your troops can then use this as they plan operations when hostilities resume. So this is indeed probably one of the busiest periods for Israeli and partner intelligence.
Does their military effort want a longer ceasefire?
Well, their military right now is supportive of the hostage release. They are concerned, obviously, that they allowed hostages to be taken, and because of the failure of October 7th. And this period is allowing that innocent Israelis are returning home. But that does not undermine their commitment to eradicating Hamas.
Do we understand? Have they articulated an endgame, Norman?
No, and I think it may be a bit unfair to even think about what an endgame may be. So let me give you an example. We are in some ways in the easiest period of hostage negotiations. Once the negotiations turn to Israeli soldiers or men, you're going to see Hamas perhaps demand a lot more from the Israelis that the Israelis are unlikely to give. And therefore, this could extend the hostage negotiations far longer than Israel could permit. And also, we're looking at a period of time when the American presence among the hostages remains significant. Only one American has been released, likely because Hamas wishes to keep American political pressure on Israel. So it may well be that Americans may not be released in the initial period.
There's something that you've said that I'd like you to explain to our audience. You said it's important not to confuse procedural hang-ups with strategic differences on hostage releases. Can you just go through what that actually means, Norman?
In the early days of hostage negotiations, you've got issues such as how do you bring hostages to a safe location, exactly which hostage is going to be released, and what that particular group holding the hostages feels about their loss of that influence. And then on the Israeli side, you've got prisoners who have committed, in some cases, quite horrific acts, and the families of the individuals behind those sentences are going to be unhappy about the release. So you're going to have a process of working through this. But that doesn't mean that each side in this issue isn't interested in the release and the ceasefire. In fact, all sides involved, Hamas, Israel, the United States, Qatar, they all benefit from a ceasefire and hostage release.
Norman, can you just elaborate on the different factions within the Hamas group that are holding hostages and why they might be reluctant to release certain hostages, how this is sort of playing out in a political sphere over in Gaza?
Well, we not only have different factions among the Palestinians, primarily Hamas, Palestine Islamic Jihad, criminal groups that may have taken hostages and seek to sell them to their own Palestinian partners. But we also have a communications problem. Imagine if you're these various groups and you know the Israelis are looking for your communications and looking for your movements. How do you exchange the data and conduct those intra-Palestinian negotiations just to get that process going? It's a very complicated situation.
What do you expect Tony Blinken to do on his latest tour of the region?
Well, is going to push for some sort of continued pressure on Hamas to release not only hostages, but to think about how they would consider a day after event. There's been very little actual crystallization of what day after means. You may have anything from an international police presence to Hamas thinking it can still survive with because it will retain hostages for a period of time. And these talks are ongoing among all the various partners. And perhaps most important here are going to be the Saudis, because they're leading such a large portion of the Islamic world. In Israel, it's really to make sure that he has a sense of where the coalition is in terms of resumption of hostilities and how Netanyahu is handling the various hostage debates within his own government.
Norman Rule, Aaron David Miller with us yesterday was just brilliant on how this is not 1967. If that is true, and if there's not going to be a Camp David visit, a Camp David Accord, whatever our memory is of normal diplomatic ties, what do you presume will be the administration's approach to finding some kind of accord? Where are we a year from now, 2 years from now?
Very difficult to think forward. First, you've got to identify which partners are going to show up for a Camp David style agreement meeting. I mean, think about it. Will Benjamin Netanyahu survive in his current political situation? It's doubtful. Who is going to be the leader of the Palestinians? Abu Mazen Mahmoud Abbas, the head of the Palestinian Authority, is 88 years old. There will be no Hamas presence at the table. So who do you bring to the table? Those entities don't actually exist at present.
That's a massive question. Norman, it's great to get your view. It always is. Norman Rule there of the Centre for Strategic and International Studies. We could have a 6-day truce, Tom. 6 days. This is a much more constructive moment. Hostages returning back to Israel. 6-day ceasefire. Temporary truce, call it whatever you will. The UN indicating that they've been able to scale up delivery of humanitarian aid across Gaza. That's the good stuff. Let's talk about where we are in a week, a month from now.
Right. Well, to me, John, what's so important to me is you said 6-day. Every day this is improving. The moment we're in right now seems to be better than the first day of ceasefire, second day of ceasefire. But I guess ceasefires end, and then what is the arch question?
The fact that Norman Rule was talking about that Tony Blinken wants to talk about what's next, and that we really haven't gotten much clearer of a sense. The fact that Elon Musk in his tour of Israel yesterday was talking about how he's going to help rebuild Gaza. It gives you a sense of just how much of an open slate this is right now in terms of even just discussion points. What is going to be the involvement of surrounding nations? This, to me, is going to be a key question of other Arab nations that have said, we want no part in this because we're not going to clean up Israel's mess. And yet, how do they evolve from this?
You know, not that it's Lindbergh 1938, but how does, which was not a correct analog, but how does the administration respond to Mr. Musk's efforts? You know, I don't know. It's like Jane Fonda.
They ignore it, and then they move on. That's what I think happens.
Look, Elon Musk to one side. I think Norman absolutely nailed it. Negotiations are hard enough. Who are you negotiating with?
Exactly. Yeah.
That's key.
To Norman's point, that's all that kind of matters. Yeah. Equity futures on the S&P 500 just about unchanged from New York City. This is Bloomberg. Equities on the S&P 500 shaping up as follows. Slightly negative on the S&P, same as yesterday, snapping that two-day winning streak. A soft start to the week, just a little bit lower in the equity market. On the Nasdaq, going absolutely nowhere this morning. Luxury over in Europe having a difficult day, TK. Blame HSBC, blame China. What's your poison?
A couple other shops out there as well. And, it's sort of the year-ahead outlook, and the outlook is to pare the price targets a little bit. 3% decline here, but far more importantly, off the joy of, 6 months ago, something like LVMH, Louis Vuitton is down 25%.
From the April high.
Shares are on sale.
Yeah, HSBC.
There's no sales in the store, but the shares are on sale.
HSBC out this morning, Lisa, saying these names are not recession-proof based on what's taking place in China.
And how much is that the buy now, pay later? I'm going to just tee you up because I know that this is something that you're thinking about, but how much is this? Because those names are some of the entry-level luxury that a lot of people tried to get into when they were flush with cash during the pandemic and are going to have to refrain from indulging in.
But it's not the brands, it's the entry-level luxury goods.
Yes.
So things like a leather belt with a Gucci emblem on it, sort of buy now, pay later, the lines of stuff that you see, I think that's really faded coming out of the pandemic. You can sense that. And also style's shifted, hasn't it? Aren't we talking about stealth wealth?
We are.
Silent luxury.
Well, I think,
Brunello Cucinelli.
I think some
Laura
people
Piana.
are talking about that, yes. But I think that more, it's also just that people have to cut back. And maybe people are feeling uneasy.
Don't like the big logos.
You don't?
No, hate it.
You've always hated it.
Hate
this
it.
isn't a new thing, is it?
Can't stand the big logos on stuff. TK's
I'm
the
looking
same.
at buy now, pay later, Affirm, which, full disclosure, I use a fair amount. John, it's had a bull market rally
That
from
always surprises
160.
me. It always shocks
from
me
160
every
to
time
30.
you tell me that you do that a lot.
I can't stand
Flights,
charge cards. How can you do
luxury
charge cards with a 30% interest rate?
But
so
you don't.
you prefer to do buy now, pay later?
Yeah, and then you pay it off quicker. You pay it off quicker.
but
No.
hold on a
There's
second.
so many of them, there's no interest rate.
But there is no interest rate on them. That's true. But you've got to pay it off in monthly components.
You pay it
But
off quicker.
There is no interest on credit card debt if you pay it off every month.
Yeah, but people don't. I'm, like me and anybody else. This is how James Diamond makes the bacon, and the answer is, it used to be easy. 18%, you could rationalize it. 30% is biblical. I mean, I'm sorry. 28%. It's like Old Testament.
I thought you'd go after the points on the credit card.
They do go
opposed
for the
to buy
points.
now,
The
pay
children.
later.
I don't use them. The kids use them. Dad, I got to fly
how
to
it
Los
goes.
Angeles.
Bond market, 2-year, 10-year, 30-year, shaping up as follows. More on that a little bit later. Your 2-year down a basis point, 487.50, just backing away. Auctions yesterday, front end was kind of softish, right, Bramo?
Yep.
5-year decent.
Yep.
Further down the curve.
Yep, the 5-year actually came in better than the 2-year, but both of them pretty low drama. Have we seen the end of volatility, or I would say, is the next big move down? And I think that that's sort of what people are playing with because of economic data that's coming in a bit softer than expected. I'm talking about the home sales data, but also some others. And then you have people actually buying, and that's sort of, triggering some sense of
7-year
confidence.
today.
Where's your next 50 basis points coming?
Thanks, Tom.
Up or down? 7-year auction.
That's a
yeah?
big call. No, what you just said
What's your
there
next?
is a
I know,
really,
but
really interesting call.
You often talk over me. So let's move on. Foreign exchange, the euro against the dollar, shaping up as follows. The euro on course for its best month of the year in the month of November. At the moment, 109.57.
Aren't we like unched in the last year?
Positive on the euro for the month, Tom, by about 3.6%.
Okay.
So there you go.
110.
Yeah, pushing it. You are. Under surveillance this morning. Let's get your top stories. Israel and Hamas extending their truce. The pause in fighting will now last 6 days, and Hamas will release more hostages. Secretary of State Antony Blinken will make his 3rd trip to Israel since the war broke out. His office saying his visit will be aimed at pressing for a long-term solution to the crisis, including the creation of an independent Palestinian state. Those objectives to one side, because that is just immensely difficult, complicated, and we've seen that play out now for decades, Tom. The longer this truce goes on, the pressure that builds domestically here in America on this president to try and lean on Israel to change course when they're not going to just gets greater and greater and greater.
In America, that's obvious, but I'm interested in the less obvious Germany, the United Kingdom, and other allies. The same pressures are there. But, to me, each country has a different story about Israel. To me, the length of time helps the tragedy, but I really don't know what it does to the diplomacy.
Just when you take a step back, the message from Hamas has been quite clear that they want to eradicate Israel. How do you come up with a two-state solution? Israel has basically said, we want to eradicate Hamas. They're not backing away from that. So I don't really see a resolution here. And this is the tricky part. Who's going to step in to rule to really oversee any kind of new Palestinian state, any kind of rebuilding. It is not clear, because it is not going to be Hamas if Israel has anything to do with it. And this is really the tricky aspect.
To your point, Lisa, is this about just changing the optics for the administration when they know they're under pressure domestically within their own party to start pushing for a solution to all of this? It was shoulder to shoulder after the terrorist attacks on October 7th, and you can just feel the tone changing. What was once a fringe view in the Democratic Party has started to become a consensus view, Lisa, in just 2 months.
There is a consensus about ceasefire, about a lack of tragedy. And how does he deal with the fact that people are calling on him to mitigate and to really dramatically reduce civilian casualties, civilian deaths, people dying, and the tragedy that we've seen unfold in Gaza? It's unclear to me how they're going to proceed forward, and if this is going to be a cosmetic or optical kind of gap that starts to grow between Israel and the U.S., or whether that's actually going to result in conditions on aid and things like that.
More on this story a little bit later. Let's turn to this one. Former President Jimmy Carter expected to travel to Atlanta to attend the memorial service for his wife, Rosalind Carter. President Biden scheduled to attend, as well as all of the living former First Ladies. Rosalind Carter died at her home in Plains, Georgia, early this month at 96. Lisa, quite a day set to unfold down in Atlanta.
Melania Trump is going to be there. I thought that was kind of interesting. The former President Trump will not, but she's going to be there as a former First Lady, which I find kind of interesting. Will also be pretty wonderful to see Jimmy Carter, 99 years old, has been in hospice, also being there.
And very fragile. Linked together will always be Mrs. Carter and Mrs. Ford, Betty Ford. And they took it on from Nancy Reagan, who was different, was more assertive, but I would give the credit to Carter and Ford. They redefined what a First Lady is, John, in America.
I think Lisa nailed this in the past couple of weeks, Tom. What a phenomenal love story. Jimmy Carter in hospice care since February. Lisa making the effort to be there and attend this funeral a little bit later.
They were married for almost 80 years. 77 years they were together. To me, that is just an epic love story that started when she was born and he was 3 years old. Amazing. And that really gives you a sense of that connection.
Whatever your politics, this was an inner humility of President Carter. And it came out of him being at Annapolis and being sort of quiet and Southern, and also many would credit him to be our smartest modern president. Bill Clinton probably would disagree with that, but Clinton and Carter certainly had some academic chops.
Bill Clinton's opinion of himself?
No. Bill Clinton is razor sharp, whip smart, and so is President Carter in his own way. But they redefined an era, and remember, they had to fight us through the dismal 70s. It was called the dismal 70s.
It was a tough time. It was a tough time. We can talk more about it a little bit later. Let's finish on something far more commercial. No spending slowed down for the US shopper after online sales on Black Friday broke records. Adobe predicting Americans spent as much as $12.4 billion on Cyber Monday, a lift from its initial forecast. The record Black Friday numbers played a part in Adobe boosting the outlook, as did the popularity of, drumroll Tom Keene, buy now, pay later options.
There it was. And the good news is I got just under 12.4 billion emails telling me something was on sale. Was your phone like just mental?
5 a day from the Gap.
Yeah, exactly.
And the sales just get greater as the day progresses. So I'm like, I'll just wait a little bit longer. Apparently it goes from 60% to 80% off.
Do you message them back? Deal with your back-end channel and how it gets delivered.
Bramo, it took me a long time to figure this out. And forgive me, it took me a long, long time to figure this out. I didn't realize you could go to the bottom of the email. Unsubscribe.
That's a rule.
In this small
yes, I do it all the time.
It took me years to figure this out. So I just sort of sit there and just
I'll sit there with a beverage and do 10 unsubscribes just to get rid of them.
Don't want the emails, TK.
And then come back. Let's move on. And right now we're going to move on to this core front and center debate, which is rent, what it means for the greater economies in the United States and, of course, in the United Kingdom. Jennifer McEwen is Chief Global Economist, Capital Economics. Jennifer, I want to go narrow on you, not the bigger global picture, but the importance of rent disinflation. It seems very different in America from in the United States. I saw the Scotsman up in Edinburgh and Glasgow talking about rent inflation in Scotland as well. Tell us how rent affects our economics.
Well, rents are obviously a major part of expenditure for a lot of people. So they're affecting spending power, the amount that people have left to spend on discretionary items, and how they feel, how confident they'll feel. Also, of course, there's an influence on house prices. So rents generally affecting the whole of the economy. The extent to which they feed through into consumer price inflation, really quite different. It's a much bigger factor for US consumer prices than
How does
in the UK or Europe.
How does capital economics feel about that? Do we feel disinflation is in place on the cost of housing?
Yes, I think so. Certainly in the US, and newly agreed rental agreements suggest that there's going to be a further very sharp slowdown in rents. And I think probably we're going to see some rental disinflation in Europe as well. But as with other aspects of this sort of disinflation story, I think Europe's a bit behind, and it's likely to be the case that the slowdown is a longer time coming.
Jennifer, what's your rate cutting forecast? It seems like everyone's trying to outdo themselves, and we're seeing 175 basis points of Fed rate cuts next year from, I believe, Deutsche Bank. We're looking at 100 basis points from the same team over from the ECB. Do you agree with those kinds of projections?
Yeah, we do for the Fed. We think that the disinflation story is really entrenched now in the US. It's pretty clear that core inflation is going to come down further. I think we'll see probably more of that in the core PCE deflator later this week. The economy, of course, still very resilient, but there are clear evidence that the labour market is starting to loosen. Wage growth is coming down. We think that's all going to play into further falls in core inflation, even if the US economy remains relatively resilient. And we'd expect to see something like 150 basis points of cuts from the Fed next year.
Are 150 basis points from the Federal Reserve of rate cuts next year consistent with the idea of a soft landing?
Yes, yeah. I think it's very much consistent with that idea. That would still leave interest rates kind of not in accommodative territory. If we were in a recessionary situation, then it may well be that the Fed would cut by even more than that to try and get interest rates loose and to try and give some more stimulus to the economy. Instead, what we see it doing is just easing rates back towards more normal kinds of levels as the economy softens. Now, of course, as with all of these kind of soft landing type stories, there are downside risks. It's quite possible that either inflation is a bit stickier, rates have to stay higher, or that it comes down much further. But our view is that in this instance, it will be a relatively soft landing for the US economy.
Can we just now the threshold for this Fed to cut interest rates, Jennifer? Standard Chartered, Eric Robertson, saying unemployment at 4.5%, core PCE at 3% should set the stage for rate cuts at the Federal Reserve. How do you see it?
Yeah, I think it probably should do. Wage growth is going to be really important, of course, but I think currently it's slowing. As long as it gets down to rates of perhaps about 3.5%, that should be consistent with the Fed's inflation target, given what we're seeing, the relatively positive signs we're seeing on productivity in the US. I think further softening of the labour market is going to be really important, as is a further decline in rental inflation, as we mentioned earlier. And if those things are in place, then I think that is a situation in which the Fed could cut, even assuming that the economy is continuing to grow.
It's a conversation they refuse to entertain. Jennifer, thank you. Jennifer Micchiano, Capital Economics. I see that not changing anytime soon, including this week when we hear from Chairman Powell. Bramo, it's very frustrating for a lot of people, this soft landing talk, but let's go through it. What is the bet for next year? It's kind of like substandard growth, below potential, but not a recession. Unemployment climbs just a little bit, and inflation's on a convincing trajectory back towards target, and they can deliver rate cuts. Is that it?
It's stealth transitory. It's basically the return. Right. It's transitory delayed. The inflation is just on a de facto basis coming down after the distortions of the pandemic, and that's going to lead to low inflation but solid growth, and everyone can be happy.
And they get to say we were right.
Correct, and we did it.
It was just transitory for longer.
Mission accomplished.
Right. We letting them get away with that.
Let's see. Maybe they'll actually prove to be that's the case.
From
New York City this morning. Kumbaya.
China is not going to be any growth or positive story in anywhere next year, but the renminbi remains controlled. I mean, this is not exactly what you would call a completely freely floating currency. So I think the authorities are going to continue to keep a really close eye on this, and we've seen this happen, of course, over recent weeks and months. That's not going to change. What we really need is growth in China and not disinflation.
That's not going to change. That's the view from Sonia Martin, the head of FX and monetary policy at DZ Bank, live from New York City this morning. Good morning. Here's the price action. Your equity market on the S&P 500 shaping up as follows. We're negative here by 0.1%. FX doing absolutely nothing this morning. The euro 109.54 and totally unchanged. This month, though, big moves. The dollar heading for its worst month in a year. Traders continue to bet on rate cuts going into 2024. Mark McCormick of TD Securities seeing more weakness to come. Here's the quote. There's growing evidence on both the growth and inflation sides, pointing to a slowdown in the US, with the Fed likely to stay on the sidelines. This takes away a big support factor for the dollar, which was already looking stretched on our positioning and valuation models. TK, the euro back to about 109.50 this morning.
It's an important conversation because we're all asleep. The FX market, I mean, we're just basically asleep. Nothing's moving.
About us.
I'm getting some joy this morning. Turkish lira may give me 30 to 1. And there's Argentina's drama, but everything else is asleep. Mark McCormick joins us now because we're not asleep. Global head of EM and FX strategy, TD Securities. Mark, is 2024 a year of big figure moves?
Yeah, I think it can be. I think one of the biggest questions we get about next year is whether or not inflation moving lower and rates coming with it is good or bad for the currencies. And I think one of the things that we saw, especially in G10, is like 2023 was an inflection point. 2022, all we cared about was inflation, where inflation goes, buy the currency. Then we get the transition in 2023 from inflation to growth. And now what we're handing over is inflation's coming down and central banks can cut rates. What that will do is boost growth expectations for 2025. So I think how much the transmission comes through in higher rates, and there's countries specifically in the G10 that have housing issues, which I think is going to come to the fore, especially in certain countries next year. But I think the transmission is really going to be which countries can outgrow the others next year.
What does the dollar call then? I mean, off DXY or Bloomberg Dollar Index or pick a pair, euro, whatever. What's the call here? Give a scope and scale to the end of 24.
Yeah, so as an anchor point, I'd say the euro is around 115 for the end of next year. So we're seeing big moves there, probably not from these levels. I'd say essentially BDXY, when we start to include emerging markets where we still kind of like the story there, I would say it's a 10% drop from the current levels that we've seen. So we are looking for kind of a substantial move where there is broader participation. I think one of the most interesting things about FX the last year and a half has been G10 emerging markets are doing different things. They trade differently on terms of trade and commodities. One's a winner, one's a loser. They trade differently on carry. And those have been the two factors that have been the most dominant things that are driving FX.
Let's not bury the lead. FX calls based on housing. Love it. Let's go there. Mark, I think Canada, the UK, Australia. What are you thinking about? Where, how, why, how big are the moves going to be?
So the interesting part is I think Sweden is a case study because what you're trying to do, and I think what a lot of FX strategists are doing right now, is you're trying to figure out the mortgage structure of the pass-through to rates. U.S. has been absolutely completely insulated from this because it's the 30-year fixed. So if you look at the U.S., we are now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year, which is kind of our anticipation. But there are other countries. Sweden was one of the first to go because most of Sweden's mortgages are variable under a 2-year tenor. So if you think about which countries matter next year, I think Canada is going to be a big story because the mortgage resets that come through from the pandemic period are going to start to reset in 2024 and 2025. So, and the other thing is Canada's been cushioned by the excess savings, largely, I think, which is a function of the related lockdowns. So Sweden was much more open, has a different mortgage structure. Most of the mortgage were short term. It burned through its savings fast. The currency's been one of the biggest laggards, and we've seen a bigger recession in domestic drivers. So if you think about a story that I think is going to be very interesting for next year in FX, is North America is the center of the slowdown. Asia is the center of the recovery, and Europe sits somewhere in the middle, but is much more, the assets are correlated to Asia.
So, Mark, what do I want to play that against? Sweden versus what?
The way that we've actually, we've seen a lot of interest in this because it somewhat neutralizes the dollar. So you sell Sweden versus Poland or Hungary. Hungary is your carry story. You've got interest rates that are double digits, even though they're about to cut. It's not happening quickly. And Poland is actually the recovery story for core parts of Europe, core parts of the manufacturing, and some of the stability that you see in the Eurozone. So the indicators that we track show a significant jump in Poland as an attractive alternative to Sweden as a laggard.
I want to just understand a little bit how housing plays into this, whether this is going to be a weakening in the overall economy if you see housing prices plunge, or if this basically pushes central bankers to lower rates much more quickly in order to stave off mass defaults and, just evictions across the country. Which is it?
I think it's a mix of both. I think it's them trying. I think it's like we can all feel the disinflationary forces. And I think an important point is central banks are going to cut regardless of kind of the setup for next year, largely because as inflation comes lower, real rates will be punitive if they don't lower nominal rates. So in very simple terms, they need to keep real rate consistent. So if inflation's dropping, they need to bring nominal rates lower just to kind of maintain a preferred real rate. So I think part of it is that a lot of central banks do know the structure of these mortgages. They know when they're going to reset. And I think, especially a country like Canada, the big issue is going to be its biggest trading partner slowing, and its domestic market is going through a massive reset where we're going from mortgage levels that were associated with, kind of the start of COVID, and we're talking sub 2% on some mortgages that are going to jump to potentially 4 and 5%. So if you look, again, you think about Sweden, what happened is that its core market, the places it's exporting to, the place it's associated with growth, that market slowed quite dramatically because of the terms of trade shock, and then it dealt with its domestic housing issues. So I think that is kind of the playbook. So we like looking at North American currencies, Canada, even Mexico. Mexico underperforms Brazil. Canada underperforms, say, Australia, New Zealand, as those are associated with more robust growth in China for at least the first half of next year.
How much distance is there in the inflation stories between different nations? And I'm talking about developed market nations, given the fact that basically there is this global inflationary push that's leading to a disinflation that's slightly different depending on the region.
Yeah, I'd say the diffusion indicators that we track are all kind of synchronized now. So there's not a huge amount of variation across different countries for inflation profiles. Again, most of it is kind of seen in the G10. I think a big part of which central banks are moving, which ones, you could see it particularly in EM, because EM was the first one in, and now they're kind of the first one out. You're starting to see it in Hungary, you see it in Latin America, we've seen BCB, Chile. These central banks are all starting to cut because they were ahead of the curve and they basically stabilized things. Benico is the one that will be probably the most aligned with what's happening with the U.S. So again, I think in the G10, inflation is probably driven much more by a common factor outside of some of the housing stories we mentioned. But that's going to be the differentiator.
Mark, I don't want you to traipse on Bart Malik's territory. You're a great commodity analyst, but I've got to ask about dollar linkage to gold. The great call of the pandemic is Dennis Gartman looking at gold and weakened Japanese yen up a ginormous 70%. Link gold dynamics right now to your weak dollar call.
Well, I feel like it kind of comes through one variable. I'll try to play Bart as best I can, but essentially it's a real rate story, right? So, the number one indicator I think you could use to kind of track gold is looking at real rates, and that's kind of the same link that you see when people talk about Bitcoin or crypto, which is that one common link is the correlation to the plumbing of finance. And so essentially on our call is we look at it this way: the delta of growth, the delta of rates, and the regime of the yield curve. We are moving into a bull steepener regime, which is unequivocally dollar bearish in all other yield curve frameworks. So real rates are coming lower. We're seeing growth deltas switch between the U.S. and China. Eurozone, again, sits in the middle. And that is essentially when you kind of look at a broader framework for the dollar, that is what would push the dollar lower, and along with the yields and the Fed being repriced are environments or things that would drive gold higher as well.
Mark, thank you for taking us down the foreign exchange rabbit hole. Swedish krona,
that was
Hungarian
great.
foreign.
That was great. What
Mark
he said there at
McCormick
the end.
of TD Securities, just on the dollar,
Lights
just to
out.
put it quite simply. Yes, we're betting on rate cuts. The surprise index, the city produces that we have here at Bloomberg as well. Where is the data relative to expectations? It's been rolling over really quickly.
Rolling over is an understatement.
Yeah, big time.
Citigroup Eco's coming down.
Next hour, clinic on fixed income. The people who were right on this bond market, on rates at the Fed. Katie Kaminsky of Alpha Simplex, Bill Dudley, former New York Fed president, all in the next hour. From New York, this is Bloomberg.
The slowdown is here and it will continue. We still have the worst ahead of us.
We can actually see inflation moderate without going into a recession.
By the end of December, first weeks in January, that's when we get that uh-oh moment and that we went too far.
You have to have a little bit of humility when you look at these forecasts.
The market is volatile right now because nobody really knows what to do or what to expect.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Slow down, what slow down? Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500. Last Sunday, the busiest day in history at airports in this country. TK, Black Friday. Best on record. Cyber Monday expected to be the biggest Monday. Cyber Monday on record. TK, where is that slowdown?
The combination of the two, I think, is germane. And I was told JFK was sport as well. I'm sure around the nation, you're all seeing it on radio and television as well. You're right, John. Every time you bring these up, you go, okay, what's the problem here? And we're going to get economic data today that may underscore that because there's a lot of housing gloom out there. And we're going to really find out if there's price elasticity with yields coming down. I'm not so sure there is.
And jobless claims just around the corner as well. Bear in mind, jobless claims last week, Lisa, 209,000 on jobless claims. So claims are low, unemployment's still low. Payrolls growth still looks decent. City looking for 200K plus next Friday in the payrolls report. And Lisa, looking at the numbers coming out of Black Friday and Cyber Monday, pretty tremendous spending going into the holiday season.
Consumers are doing really well. How do you compare that to a Walmart CEO coming out and saying that they're seeing a dramatic pullback in consumers over the past 3 months? How do you pair that with what we heard from Best Buy, we heard from Target, we heard from a lot of the retailers? It doesn't really work unless there are different trends in different sectors, which is the reason why it has been so hard to get this economic cycle right.
We did, what surveillance does. We talked to Dana Telsey and Oliver Chen back to back. Those are two hugely competent. You should see Dana Telsey in a TJ Maxx. She gets into aisle 4.
You've never been
People
to a
just
TJ
clear
Maxx.
People. I saw Dana once at aisle 4 of TJ Maxx. People clear out. She's so intimidating.
Now I know you're making it up. Let me give you a number you can get your hands around.
Please.
This from Reed Pickett here at Bloomberg. It now requires $119.27 to buy the same goods and services a family could afford with $100 before the pandemic. Tom, if I can pick only one number that matters right now to how the consumer feels about what's happening in America, that's it. That number right there.
Economist of the Year, Lyle Brainerd, silent at the White House. She was doing better as vice chairman. We heard more from her. And she gives credit to the idea of cumulative. It's not year over year. I've said this 8 times. I'm sorry.
It's
I'm
not
boring
month
people
over
at home.
month. I'm with
It's not
you.
month over month. It's this cumulative study that Pickett's study is great here. The latest number I saw is groceries from the beginning of the pandemic up 17, 18%.
Up 25% in January 2020.
Wow.
That's the number that matters, Tom. No two ways about it, without a doubt.
Do you know what I'm paying for a fancy overpriced
But don't you think
apple?
we need to talk about how we talk about inflation in this country on programs like this, when we sit here saying month over month it's this, core is this, inflation is slowing, and then you've got a whole group of people away from Wall Street that are just sitting there like, what on earth are you talking about?
Well, we've always talked to both audiences, but to your point, John, our answer is we have to have the responsibility to do both. We got to play the eco-go game. As you say, claims coming out, extremely important. The adjustment second quarter GDP, third quarter GDP, second look, I should say, 5%. An uptick is the model right now in that statistic, but then we got to look at the real world as well.
Well, real wage growth is good, but is that the real world? I mean, a lot of economists would say absolutely yes, but I don't think, Tom, people should be telling people how they should feel. I see so much of that, Bramo, when people stare down a camera and say, we should feel better about this economy. This is how you should feel about things. And then you go through numbers like that. You look at the cumulative inflation over the last 3 years. Let's not talk down to people about how they should feel about this U.S. economy.
Things are a lot more expensive, and what people feel is that they can't spend, they can't buy as much with their money, and that is a very real feeling. The key question is, what is the remedy? Is it time where things just stabilize for a period of time, given the fact that people have earned more? Or is it a more material deflation, which typically is negative? Although if it's goods deflation, which we are seeing on the margins, could that give a bit of a lift?
Extremely well said, and the answer is the x-axis. You work it out over time. What I suggest, John, is we've had a massive pandemic stimulus. That was the choice of America. Did that stimulus, was it equally applied across 300 million people? The answer is no. The stimulus benefit went to the haves, and the have-nots across broad middle class got crushed.
Let's turn to the scores. Your equity market right now, Tuesday morning pulling back by 0.1% on the S&P 500. Just a touch lighter over the last 24 hours, yesterday and this morning. Yields a little bit higher by a couple of basis points, Lisa, up to 440.40 on a US 10-year.
Wow. So big. Actually, the volatility really seems to have ticked off and slowed down. 9 a.m., I'm really watching housing price data coming out, CoreLogic, Case-Shiller, 20-city home price index data, as well as a whole host of other series. To me, yesterday, we got new home sales, and we got that the median price had fallen 18% year over year. Is this a blip with home builders discounting their inventory, or is there something broader going on, given where mortgage rates are? 10 a.m., Chicago Fed President Austin Goolsbee and Fed Governor Chris Waller kick off a day of Fed speak. Yes. We also hear from Michelle Bowman as well as Michael Barr later in the day. And then, of course, Goolsbee again. And at 1 p.m., U.S. Treasury is going to auction off $39 billion of 7-year notes. The duration bid. I am very closely watching this. I think it's important because at this point, can we say the bid has really gotten back and really dampened volatility more significantly in the bond space?
Bramo, thank you. Let's talk about that bond space. Katie Kaminsky, Chief Investment Strategist at Alpha Simplex, joins us now. Katie, the journey, the low on a 10-year yield back in 2020 in spring, 50 basis points. The high over the last couple of months, through 5%. It paid to be short, this bond market. You have been short. But the turnaround in the last couple of months has been brutal the other way. We've come from 5% down to 440 on a 10-year. Katie, you've been short. Are you still short? And if you are, why?
Yes, still short, but that has to do with different signals having different views. Take a look at the chart for the year. If you look at the year chart, the last month has been a miraculous turnaround relative to where we've come. So we're still way ahead of where we began the year, even prior to what happened and post what happened in the regional banking crisis. And so I think the key question to ask yourself about bonds right now is, where are we going next? We have been looking all year for a disinversion of the curve, and we got that in October. And the next point is still really uncertain. Are we moving to a steeper curve? And if so, which way? Or are we just going to move around in sort of a range until we figure out what's actually happening with the Fed?
Katie, why is it not as simple as taking a look at the economic data coming out, showing that it is disappointing much more frequently than it is outperforming, and just sort of leaning into that, which the rest of the market seems to be doing?
This is a good question, because really what I find the most concerning about the last month is there's been a massive risk-on rally on weaker economic data. And that to me is sort of a relief rally from where we've come, because we've been through a lot, particularly in bonds. And so I think most people are buying right now because they're saying, if we see cuts soon, then we know that yields are going to come down. My concern is that it could take a lot longer than people think, pointing out that inflation is still way above target, or at least 1% above target. So we could take a year or so to get there. People are very quick to think that things are over when they take time to actually get through the system.
Katie, we're setting up for the new year. I want to go back to the advent of all this, and this is trend-based studies, and it's Andrew Lowe, the giant, and working with Alpha Simplex and Wells Wilder and Monroe Trout, John Henry, and the rest. And the germane question 20 years ago is the same today. If you look at trend-based studies, or the complexity of trend-based setups, are they elegant right now? Is the math good, or are you blind?
Well, turning points are notoriously difficult for trend following. It's because we're not really set up to pick the tops and bottoms of big moves. And what happens in these turning points is we have to figure out, using math, where is the next step of the trend. And that's where right now is an inflection point. And I'm looking forward to see if we can actually see that steeper curve. And when we've done historical analysis, what you do see is flat curves or steepening of curves is very difficult for trend signals because it's moving. Everything's moving.
So if it's a stochastic environment and you've got to find a new trend, what is the key attribute for our listeners and viewers to establish the trend?
Well, I think the key thing that we always think about as trend followers, we try to blend different views. So right now, the long-term view is still cautious. The shorter-term view is very, very optimistic. And if you combine those two together, you're really sitting in a situation now where we need more data and we need more time to understand where the market's going next. And that's why I think the market is so focused on every data point that comes out, because we're trying to sift through which view is correct. Is there a new trend? Have we moved to a new era, a new phase of the curve shift? Or are we still sort of treading water trying to figure that out?
Time is expensive for shorts, and that's something that we have seen play out again and again. How much are some of those short positions being washed out, adding to the rally, the stability that we've seen in bond yields over the past week, and something that you think maybe can't last?
Yes, of course, but I think there's been plenty of shorts this year, especially last year as well, when you think about where we've gone. We definitely need a balance between shorts and longs in this market. We have seen more buying pressure recently, which has been kind of perhaps causing some deceleration or deleveraging in short positions. But from the trend space, that's a strategy that's much more slow moving than some that you might be discussing. But there are definitely potential that some people are unwinding shorts as well.
Katie, thanks for the update. Still short on this bond market. Katie Kaminsky of Alpha Simplex. Here's an update we mentioned yesterday on Deutsche Bank, the outlook for bond yields. This is what I think is really interesting about fixed income right now. If you ask for a forecast, a call, a price target, a yield target, if you will, into next year, there is far more confidence about the front end than there is the long end. Mm-hmm. At the front end, directionally, the Fed's going to cut. Seems to be the consensus view. By how much, we can discuss that. But at the long end, you get a very, very different range of views. Take Deutsche Bank, for example. On a 10-year, their call is for a move to 4.05%. Now, bear in mind, Deutsche Bank thinks you get a ton of rate cuts next year and a recession, and yet their 10-year call on a US Treasury, Lisa, is 4.05%. The 2-year, the call is radically different. They're looking for a move of more than 100 basis points lower. That's what I think is interesting about the calls going into next year.
Monetary policy versus fiscal policy. How much is that essentially what you're seeing in the differential between 2-year and 10-year calls, given the glut of issuance at all of these auctions that we keep talking about?
And all the overlay here of every nuance of every bank is the basic idea of will there be a GDP slowdown, and with that, some change in the unemployment rate. John, you've mentioned twice here claims this week. I'm going to take the 4-week moving average, and there's a 209 in there from last week, and that flat out doesn't get it done.
Based on the estimates I'm looking at this morning, sneak peek of Thursday, looking for claims maybe to climb about 10K.
Is that a guesstimate? I don't know. How hard they were?
It's a best guess. It always is. Yeah. If you are just joining us, welcome. Your equity market negative 0.1%. Yields a little bit higher by a couple of basis points, 4.40 on the US 10-year. Cameron Dawson joining us in the next hour from New Edge. She'll sit around the table with us at about 8 a.m. Eastern time. With us here in New York very shortly, in about 15 minutes' time. TK, one of your favourites, Ian Lingen of BMO on this bond market.
And he's been right here. Just a general statement with lower yield. He said load the boat on the 10-year yield, and you make a call that bold if you're Ian Lingen.
He said screen and buy, didn't he?
Yes, he did.
Screen and buy.
And then
is he to Deutsche Bank's 405, or does he think it's a 3-handle? And that's the kind of dynamics where you can make some real money if you have conviction. I don't have conviction in it now. I mean, I'm worried about the high drama out there, and what we've got is low drama Bramo.
Low drama Bramo.
Low drama Bramo.
What's low drama Bramo?
She says there's low drama out there right now, and it's like low drama Bramo is we're just sort of.
I'm going to make some to just sort of add to the whole feeling.
You get a 3-point XX. That's not low drama.
What I think is interesting, actually, pointing to low conviction. Chris Harvey in his outlook for next year, talking about it's a trading market. Just go against everyone else. I kind of relate to that.
I saw that note this
morning. That doesn't make for good TV and radio.
Good news is bad news, and it's going to be volatile.
Lean against everybody
first
else.
Half.
Yeah.
Bill Dudley's going to join us a little bit later of Bloomberg Opinion, the former New York Fed president. That conversation just around the corner. From New York City this morning, good morning.
are in some ways in the easiest period of hostage negotiations. Once the negotiations turn to Israeli soldiers or men, you're going to see Hamas perhaps demand a lot more from the Israelis that the Israelis are unlikely to give, and therefore this could extend the hostage negotiations far longer than Israel could permit.
That was former senior U.S. intelligence official Norman Rule as Israel and Hamas extend their truce after agreeing to release more hostages and prisoners. More on that in just a moment. Live here in New York City, good morning to you. Your equity market looks like this. The scores shaping up as follows. Worldwide, in the equity market, stateside, we're negative 0.1% on the S&P 500. Into the bond market, treasuries lower, yields higher by a couple of basis points. 4.40 on the US 10-year. Love saying that, don't know why. In the commodity market, crude higher by about 1%, 75.66. And in foreign exchange, unchanged today, basically on the euro at 109.59. But still, potentially, Lisa, best month for the euro against the dollar of the year so far.
Yeah, and it really is otherwise a pretty lackluster year for the euro. It's such a non-drama day. That's the reason why I said it. I mean, there's really nothing going on, which is actually news in and of itself, because we had so many weeks of incredible volatility. And it seems to have died down. Is it just because people are feeling good? Is it because they haven't gotten back yet? Is it because they don't know what to do? I'm not sure.
Bond markets aren't grumpy anymore. Is that it? Investors have come back after Thanksgiving and we've
100%.
Conquered volatility.
That's exactly right. I mean, basically people are seeing that, you know, at least you guys aren't freaking out. We can come back. There is something to be said for that.
Yeah, the moves are smaller, Tom. Let's put it that way. They're smaller.
They're smaller, but, you know, I think, John, that I get it. It's quiet. We're waiting for data. We're waiting for December 8th, the late jobs report as well into the Fed meeting. But the answer is they're going to come up with something. And I'm going to circle back to Powell. Is it today he's speaking?
Friday.
What's he going to say?
A whole lot of nothing.
You know, well, is this a good time to give out a message?
We're going to proceed carefully, has been the message so far. And for good reason. Let's be clear about that. Yeah. Jobless claims coming in at 209 was a wake-up call for us all as we start to think about them maybe climbing higher from here. Back down to 209.
Then you mentioned
Spending
TSA.
Looks good Friday. Spending looks good Monday. TSA, record travel in American airports on Sunday. Tom, there are reasons to sit there at the Federal Reserve and wonder still if we are restrictive enough.
Well, they're not. You look at the Bloomberg Financial Conditions Index right now, perfect timing, John, 0.50 plus. That's massively accommodative, going against what the Fed wants. The idea there of an accommodative stance across, I think it's 11 ratios, says it all. Joining us now on set, this is a real treat. She's just in Washington, fighting traffic out to Dulles. Wendy Benjamin joins us, our deputy leader of all of our print efforts in Washington. And what's so important here, she was weaned at the Houston Chronicle and knows Texas journalism, the tough, angry journalism. How tough and angry, Wendy, is the House right now? I am stunned at the level of retirements, both sides of the aisle. Everybody's saying, see you to the House. Let's start with a why. Are they exhausted by the drama?
I think a lot of them are exhausted by the drama. They're exhausted by the extreme partisanship on both sides and the inability to get something done. I mean, they can't even decide on who their leader is, first of all. They've gone through so many speaker elections in the last couple of months. They can't get what would normally be a simple, very brief passage of aid to Israel or continuing aid to Ukraine or the sort of things they're going to discuss this week, or getting a budget passed. I mean, we've all gone through shutdowns before, but this fight over the continuing resolution that was passed before the holiday and all of those sort of, bills that pass, it's just taking too long.
But to your Texas journalism, and this is before you, a guy named Lyndon Baines Johnson or even Ann Richards, they pick up the phone and say, we need to fix this. We seem incapable of doing Texas politics now.
Well, yes, and that may not be a bad thing all around. But the Biden can't call the House, right? President Biden, the Republicans control the House. President Biden is a Democrat. The Senate seems to be moving along, and they are now actually trying to fundraise. Senators running for re-election are trying to fundraise off, we're not the House. We're the grown-ups in the room. We can get things done. And that's their messaging. And that, I don't think, will help House members on either side.
Can you frame just how big this fight over spending is going to be in early next year?
I think it's going to be really big because we'll be right in the beginnings of the actual presidential election that we've been talking about for a year, right? So we are talking about, the Iowa caucus is January 15th. That's right when the government would shut down again if they don't get the spending passed. So is everyone going to be thinking about the good of the country or whether their guy wins Iowa and New Hampshire and South Carolina?
We've been talking a lot about the dysfunction in the Republican Party with respect to the House, the lack of a leader, the back and forth on that. I'm wondering how much the schism in the Democratic Party is growing as a result of a lot of the disagreement over the Israel-Hamas war. Can you give us a sense of how great that is, how that's going to play out politically early next year?
Well, it's going to play out over a number of angles, Lisa. There will be Arab American voters and people who sympathize more with the Palestinian cause, who are very upset with Biden right now for his, up until now, I would say, full-throated support of Israel's campaign and Hamas in response to the October 7th attacks. And then you have people who are behind him on that. But young voters, voters of color, Arab Americans, seem to wish he would be a little more critical of Israel. And that is one of the reasons Antony Blinken is in Israel today, or on his way, is to begin a slight pressure campaign on Israel to be a little more careful about civilian casualties and to sort of show some restraint so that the U.S. can begin to have some sort of balance in its position there. But also young voters and people of color are very disenchanted with what they perceive as the state of the economy right now. And they're blaming Biden for that, too. So you have young people on the left side of the Democratic Party and Biden's crowd on the sort of center-right of the party, and then Joe Manchin, retiring and entirely so.
And possibly launching his own campaign. What does this mean in terms of who that faction of younger voters is coalescing around? Is there a candidate, or is it just simply they're going to opt out and there's not going to be the same kind of voter participation?
Well, we've had such good young voter turnout over the last few years, some of it driven by anti-Trump, some of it driven by interest in issues like police, brutality and things like that. This time, they have a choice between Trump and Biden, two guys old enough to be their grandparents or great-grandparents, and they're not excited about any of the options. So it's possible that young voter turnout will plummet again this year. And I think both sides are trying to work on getting them interested, but Biden has a mixed record on climate change. The student loan thing didn't come through the way he promised it would, the student loan relief. And now you have the split over Israel-Hamas, and I think he's got some work to do with young voters.
Not going to the climate get-together in Dubai. What do you make of that?
Well, it saves a lot of jet fuel, so there's that argument. We should also note that many presidents have skipped this. Not every president goes every time. Obama skipped it, I think his last one. I'm not sure if Donald Trump went. George W. Bush didn't always go.
Have you been?
I've
Did
never
you go
been.
to
No,
COP 10 or
I didn't go to that. No.
15?
I skipped that. Did you go to 16?
I was supposed to go to one, and I've never been.
No, I didn't go.
Been,
I just remember the standout for me was 2021 Glasgow.
Yeah.
And the contradictory messages that we were getting from the administration. We need to end fossil fuels, and in the same breath, in a different country. I think it was in Rome, wasn't it? Did they go to Italy a little bit earlier? I'm trying to remember my calendar that year, Tom. But ultimately, they were pushing for the Saudis in the Middle East to pump more crude.
Right.
Have the views changed? Are they becoming more pragmatic about the energy situation, or have they just become, as Tom might say, overcome by events, given the two wars that are taking place now?
I think Tom's right on that. I think that, yes.
You can stay.
There you go. No, I think Biden is sort of caught in the middle. He needs to keep gas prices down so that Donald Trump has less of an argument about the economy and things like that, and for the good of people. And at the same time, as I was just saying to Lisa, he has this problem with the youth vote. The youth thinks climate is one of the top arguments, and so he's got to sort of thread that needle, and they're not doing that very well at the moment.
Wendy, it's good to see you here in
Good to
New
see you
York.
too.
We should do this again soon.
Yeah,
Wendy Benjaminson there of Bloomberg. TK, on the latest.
Well, the latest, it's coming drip by drip. We didn't get to it, but overnight, President Trump going after Obamacare, and the reports are thundering silence from GOP in the Senate going, oh, really? So that shows some of the Republican divide going forward. It could be high drama.
Hey, division in both parties. Lots of big issues.
Yeah, it's within the
Big
party.
time.
It's typical. I mean, that's typical.
It's typical, but don't you think they're bigger? I think it's much
it
bigger now.
seems bigger now.
Absolutely.
Yes.
From New York, this is Bloomberg. Stocks look like this. The scores as follows. On the S&P 500, negative by 0.1%. On the Nasdaq, down about 1/10 as well. Small move lower yesterday on the S&P. Another small move lower
Did you see
this
that?
morning. I think you'd say teen twins, TK.
Massive T-swings. And like the NASDAQ 100, what I would point out is there's a lot of excuses to go down, and then the bid comes in.
The Nasdaq was down about 0.07%. On the S&P, we were down 0.2 at a close yesterday. Let's turn to bonds. 2-year, 10-year, 30-year. Small moves, conquering the volatility. Lisa thinks maybe we have done. We're up by a basis point. Lisa, I'm just saying maybe we have done. Yeah. You want me to hold on still?
No.
I'll
That's
continue.
Good. Carry on.
Resume. Up a basis point on a 10-year, 440.21. 2-year gone nowhere, 488.33. Auction a little bit later. 7-year, I'm told, Tom.
Yeah, I have no idea what that
informs
means.
me.
Can you envision
$39 billion worth of 7-year notes, 1 p.m. Eastern time.
Can you envision 3.99%? I mentally can't get there, but that's what some people are saying.
41 basis points away.
Yeah, it's like, 3-day rally
which
away.
is 2 days, maybe.
Exactly.
Yeah, 2 days, perhaps. So let's finish on foreign exchange. Talked a lot about the euro potentially having its biggest month of the year so far. The euro against the dollar at about 109.50 on the month at the moment. Just massive euro strength, about 3.5 percentage points worth of strength against the weaker US dollar. Not just about the Fed potentially cutting interest rates next month, but the data relative to expectations, the so-called surprise index, Lisa, surprising to the downside over the last few months.
In the U.S., and on the flip side, surprising to the upside on the margins in places like Germany. Things aren't as bad as people had feared. So you've got both things going for the euro. I'm not sure what that means from the disinflation standpoint, et cetera, but it's been a year for the euro that's been pretty rocky, so they could, use a little bit.
That's nice here. The dollar getting beaten up on both sides. Let's get to some top stories. Under surveillance this morning, U.S. Secretary of State Antony Blinken heading to Israel for the third time since his war with Hamas began last month. Hamas releasing 11 more hostages as part of a deal to extend its truce with Israel until Thursday. Israel, for its part, is releasing another 33 Palestinian prisoners and allowing for more aid into Gaza. The National Security Council spokesman John Kirby telling media he does not expect Americans to be among the latest, Tom, to be released.
Extend is the key word there. And as I said earlier, I just think that it becomes ever more efficacious as you get out 1 day, 2 days, 3 days. We're getting used to this, and it's very, very constructive. And the feel-good tone is there and growing as we wait for what the next is.
And then there's a reality check, Tom, that the objectives, Lisa, ultimately have not changed. Constructive that you see these hostages being released back into Israel. Constructive that you see this aid getting into Gaza. Constructive that the truce might last a few more days. Reality check. The objectives have not changed. This conflict at some point will surely resume.
Israel still wants to eradicate Hamas, has not done so yet. Hamas still wants to see Israel disappear. And that's not going to happen if Israel has anything to say about that. So you have those two conflicting messages. How are they going to resolve it without an external voice? So I wonder with the Qatar discussions and how much they're negotiating for acting as the go-between for some of the hostage releases. Are they having other discussions, too, about the what's next?
And that's the latest. And the next hour, we'll continue this conversation with Wendy Schiller. Just an update on potential IPOs. The class of 2024 could be Keene, Reddit, Rubrik, Kim Kardashian, Skims, all looking to go public in the next year. Reddit working with Morgan Stanley and Goldman reportedly on a listing that could value the company at as much as $15 billion US. Tom, elsewhere, Chinese fast fashion maker Keene looking at a valuation of as much as $90 billion US. It's been quiet for this part of the banking industry, Tom, and there is some potential here to pick up going into next year.
Are they legitimate IPO candidates? Are they too small? Are they essentially private, almost micro caps that should not be looking at an IPO? But the answer is, the froth is, let's cash out, let's get the equity going, and where will we be in 6 months?
What I find interesting is that we haven't seen any froth, right? I mean, this year has been so quiet when it comes to IPOs, at least when I'm talking about this year, not just in general going back. But there's a question of, is this going to be some sort of private equity exit, or founders exiting some kind of investment? Or is this that people see the market thawing in a real concrete way and want to move forward with investment? I'm not sure, but to me, the idea that things are coming out is a positive sign. I'm
going to defer to Shonali Basak on this, but I think the exit pressure is tangible. David Rubenstein, what a privilege to have him on with this wonderful show on Bloomberg and with Carlyle. But John, this goes to Apollo. When we visit Apollo next week, what are the incentives here? And the incentives here is they're out of patience and they want an exit of some type.
I won't speak for them, but I'll speak for the banks. I don't think the banks care. They just want the action.
They want the action.
And
Absolutely.
they're potentially going to get some action next year. I want to finish on a mover for you. Big move in yesterday's session. iRobot dropping 17% after, guess who? The EU warned its planned merger with Amazon would lead to competition issues. Amazon is looking to buy the Roomba maker for $1.4 billion. The stock soaring last week after a Reuters report claimed the EU would clear the deal. Amazon and iRobot saying they will address issues with competition on Amazon's marketplace and data collection. The stock bouncing back this morning, Tom.
Bramo, agree with me. There's no one we know more qualified to have a Roomba than John Ferro. Can you see him on Saturday morning with two of them going at once?
I am so tidy and organized. I find it therapeutic. Get the Dyson out. Just clean things up a little bit. I use the Dyson myself while I use a robot. Yeah, Saturday and Sunday. Just really relaxing stuff.
Yeah.
Wake everyone up.
It's well known that 50% of dogs go after the vacuum cleaner.
Is that
so at one point, Vet Bill or Kennel Fee are going after that beast.
You are the target audience.
Yeah, there we are. We're all Roomba.
Vacuum cleaner.
Right now, and this is the interview of the day on fixed income. In fact, I would say his visit with us last was the interview of the quarter. He's with BMO Capital Markets. Ian Lingen writes exceptionally dense, must-read notes every morning on U.S. full faith and credit. Last time around, he said, load the boat on the 10-year. Let me go right there first. Are you going to continue to load the boat on the 10-year? Price up, yield down.
I do think we're at a moment of consolidation in the Treasury market. Ultimately, we're going to end up with lower rates than we have at the moment, and that's simply because the Fed is effective in re-anchoring price stability and making sure that we end up on the other side of this cycle, not in a dissimilar place from where we entered the pandemic. And they've been successful thus far. So I would definitely still be long treasuries between now and the end of next year, but with a nod to the fact that it will be a choppy ride.
Have we re-anchored the bond market? Do you think we have?
I think we have. I don't think that we're going to retest 5% in the 10-year space, and I think that the 2-year sector is going to remain wedded to monetary policy expectations, which means that we'll fluctuate kind of in the range that we are. Maybe we'll see a 5 handle again if the Fed is effective in reintroducing the idea that they could still hike another time during this cycle, which we don't think they will.
Let's talk about conviction levels. Do you have more confidence about how things evolve at the front end or the long end of the curve?
At this stage, I have strong convictions in both, but with a nod to the fact that we tend to think of the 2-year sector as nothing more than a 24-month rolling window of policy expectations. We think that the Fed is done, but the nuance within that is that the Fed has a very high incentive to continue to keep another rate hike on the table, even if they don't believe it's going to happen, because they want to push rate cuts out as far as possible, which is what makes the December update of the SEP so fascinating, because we know that they're going to drop this year's dot to 5.3 simply to match where we are at the moment. The question is what happens to the 2024 dot. If they don't change it, then that means they're going to be telling the market that they're only cutting 25 basis points next year.
I love this game theory. And the market's not going to believe them. Basically, they're going to come out and say this, and everyone's going to be like, we know your game.
Yep.
You're trying to jawbone us into removing rate cuts from our expectations. From your expectations, do you agree with the likes of Deutsche Bank that see 175 basis points of rate cuts next year?
So I think that there's one of two outcomes is going to occur. And it's really, not to use the cliche overly, it is a gray rhino versus a black swan. So either we're going to see what the Fed is projecting occurs, which is a slow and steady increase in the unemployment rate, the real economy slowing down, and inflation coming back in line with expectations, or there's going to be an event that we don't see on the horizon. Is that a stock market crash? Is it a blow up in credit? Is it some geopolitical contagion that leads to a flight to quality in treasuries? One of those two outcomes is going to occur. At the moment, everything appears skewed towards a slower slowdown, a more moderate adjustment on the rate front, which would suggest from my perspective that 125 basis points worth of rate cuts, which is effectively what's priced in at the moment for the market, is probably a good base case, but there is a potential for the Fed to make it all the way to the fourth quarter of next year without having to cut.
This is really the key question. Is this positive for the overall economy? Is this stimulative, or is this indicative of a greater degree of a slowdown than people currently expect?
The longer it takes the Fed to cut, presumably the more dramatic the cuts will be and the more economic destruction will occur, or demand destruction that will occur. But to some extent, that's precisely what Powell is attempting to orchestrate at the moment. Because when we look, and Tom made this point earlier, when we look at overall financial conditions, the Fed has to be viewing that as somewhat problematic because they want financial conditions tighter. And so the easier financial conditions are, the higher the likelihood that the Fed delays rate cuts as long as possible, risking a bigger slowdown.
You're the grizzled pro here. I bust Lisa's chops about auctions. And of course, folks, I understand the auctions have some validity and are serious, and I should be like Ian Lingen and lean on them. Who is the bid on full faith and credit United States paper? Who's the marginal? You do partial derivatives there. Which is the partial derivative that matters? We want to own that paper.
It's a fascinating question, and that's something that we spent a lot of time debating over the course of the last year. At its essence, we have, as a market, lost the motivation of the traditional incremental buyers.
Right.
Japan has slowed down in their buying. We have seen other major central banks be a little bit less aggressive as a theme. And what has occurred is we have come to what I would characterize as the buyer of last resort in terms of the incremental willingness to add treasuries, and that's real domestic money. So whether that's big pension funds,
the wall of money,
hedge fund, and they're the most sophisticated, and they're the most price-sensitive buyers. And I think that's one of the reasons we've had real conversations over the course of the last several months about the reintroduction of term premium and why it should be at least positive. And
John, this goes to the heart of the matter, which is what to do with 5% money market funds. I mean, that's the whole study out there. When do they shift to the world of Lingen?
I'm with you. It's a big question for a lot of people. Ian, the calmest man in fixed income. It's good to see you. Thank you, sir.
Nice to see you.
Ian Lingen there of BMO Capital Markets. If you are just joining us, welcome to the program. The stage set like this Tuesday morning. Good morning to you. Equities negative by 0.1%. Yields a little bit higher by a single basis point, 439.43. Just 40 basis points away, Lisa, from talking about a 3 handle. Feels like it was only last week, because I think it was only last month, that we were talking about the potential of maybe 6 after breaking through 5 on a US 10-year.
It has been unprecedented volatility if you look at the bond space, and that has to underscore the calm that we're seeing right now in markets, the fact that we do not see that now. The fact that Ian said we've basically seen the volatility. It is behind us. We now have seen the ceiling. We're not going to get back to that 5% level in the 10-year. If that's the case, how much conviction do people get in some of these bullish calls?
I think there's a sense at the moment you've seen the volatility in the data that might be behind us, that the outlook for inflation is a little bit more predictable. I'm not here to say that's the right view. I'm just making a judgment on where I think a lot of people are right now. That view extends to Fed policy, looking out. Gone are the days where they were talking about going 50, maybe 75, back to 25, maybe even 50, and not being done, needed to do more. Everyone's on the same page now. Proceed carefully. But there are still some issues out there, Lisa, that I just don't think have been answered. We're still talking about the BOJ potentially raising interest rates. QT is still on the table. I don't think we should normalise the amount of debt that's going to come to market in the next 12 months. I will throw in the spending debate that's set to take place in Washington in only a few months. That's going to be at the very start of the year. And if you're worried about Washington's ability to agree on anything, well, we're going to have to confront that inability very early on in 2024.
I would agree with all of those things, which is one reason why we heard from Katie Kaminsky. She's not willing to say that this is the new reality. She said we cannot say that based on all of these factors and the fact that we really have seen a rally in risk, even with disappointing economic data.
On the nation's debt, Bill Dudley, former New York Fed president, up next on this program, live from New York City this morning. Good morning.
we know the prices are still too high for too many things, that times are still too tough for too many families. We made progress, but we have more work to do. Let me be clear. To any corporation that's not brought their prices back down, even as inflation has come down, even as supply chains have been rebuilt, it's time to stop the price gouging.
The President of the United States there at the White House as he launches a new council on supply chain resilience. Live from New York City this morning. Good morning. Let's get to the scores in financial markets. Stateside equities negative 0.1%. Yields up a single basis point, a break of 440 in the last 24 hours. Yields lower yesterday, 439.82 on a US 10-year. In the FX market, the euro just squeezing out a little strength against the dollar again. 109.55. We're essentially unchanged on that currency pair on the session. Anything but on the month. The euro positive by something like 3.5% on the month so far against the dollar. And a quick sneak peek of crude, Tom, and what's happening in commodities. We're up here by about 1%, $75 and about 60 cents.
I'm glad you mentioned it. I think it's one of the stories underplayed here. Is I looked at the Bloomberg Commodity Index today, and I'm sorry, John, all in, it's a low global demand disinflationary trend. You blend it all together. You know, I get it. Cocoa straight to the moon. You see orange juice, Tang sales, income substitution effect. People are piling into Tang off the orange juice surge, but everything else is flat on its back.
I'm not sure if that's true.
No, it is. There's a substitution effect.
What you had to say just then that's true, but coffee up by 23% since 2020.
But nevertheless, the Bloomberg Commodity Index is south.
I'm never sure.
I'm pretty sure that there is no Tang index, so that we can.
There's a substitution effect. Come on.
There's an economics lesson in there somewhere.
It's in there somewhere.
But I'm not sure. It was sort of like a made-up story for children.
Yeah, well, you know, that's what we do.
With an unclear message.
That's what we do.
Okay, good. I think we're done.
I think we're done. Right now, we're going to look at BitDog. We do the 37,000 here. And what's important here is to look at what people that are thinking about this think will be a constructive outcome. I'm going to play this off my book of the year years ago, Ken Rogoff's Very Courageous, The Curse of Cash. He's writing about where we are with digital currencies, what the Bank of International Settlements in Geneva thinks, what central banks, as he was at the New York Fed, thinks. Bill Dudley joins us right now, writing an important column on CBDCs, central bank digital currencies. Bill Dudley, very valuable and thought-provoking this morning. We just saw criminal trials, guilty verdicts, maybe appeals involved, but are we getting away from the presumed criminality, the punishment, the secrecy that Ken Rogoff had the courage to talk about?
Well, I think that the crypto space is in disarray right now. And the real question now is, are central banks around the world going to introduce central bank digital currencies to sort of take up that slack? I think that's going to happen. Probably going to be more evolutionary than revolutionary, because it depends on what payment system that you're starting with. I think where central bank digital currencies could play a very, very important role, and this is highlighted in a new paper that we put out by the Bretton Woods Committee, is really on cross-border payments. If we had a system of central bank digital currencies where the interfaces were harmonized, you could probably execute payments on a cross-border basis at a fraction of the cost today. For a lot of migrant workers, when they're sending their payments abroad, it costs over 5% of the value of the payment just to execute the transaction. And it's very slow. So we can certainly do a lot better than we're doing right now. Now, in this process, the Fed is very far behind in terms of their work on central bank digital currencies. And in the U.S., there's quite a bit of skepticism about the need for central bank digital currencies. I think this work will continue.
Well, that's the heart of the matter. I'm going to go to Raphael Auer, who owns the high ground on this at BIS. He's documented the incredible friction of transactions in the real world. We all thought we'd be trading Bitcoin at, John would be down at Celine trading Bitcoin for a sweater, but the answers were not. We can really get down to where this is efficacious for central banks. We can really squeeze this down to where there's no transactional friction.
Well, there'll obviously always be a little bit of transactional friction, but we can do a lot better than we're doing right now. I mean, in theory, central bank digital currencies should be a pretty significant improvement over cash. They'll be just as safe as cash, but in terms of default risk, because they'll be guaranteed by the sovereign nation. But you don't have worries about storage. You can transact with digital cash across long distances. So to me, it's like cash plus. It's superior to cash. and it's something that the U.S. should start to innovate on.
There's a concern, Bill, that as you disintermediate banks, essentially those agents that really capitalize from those frictions that exist, that some of the functioning of markets that traditionally has supported things like treasuries starts to ebb away. How concerned are you as you start to adopt new, less friction-filled methods and as capital markets slow in the wake of rate hikes? How much does that really disintermediate banks that really are still essential for the functioning of the treasury market?
It really depends on central bank digital currency design. And I think there you want to have a two-tier system where the banks continue to own the customer relationships. Central banks don't want to have customer relationships with hundreds of millions of households. So they should hand that off to the banking system. The second thing you want to do is make sure that the central bank digital currency doesn't pay interest. If it doesn't pay interest, it's basically going to be used for payments, not for investment. So that preserves the role of commercial banks as intermediaries. So I think if you do those two things, you essentially protect the commercial banking system as providing financial intermediation services, but the central bank helps provide a better payments medium.
The reason why I ask this, on a broader sense, away from digital currencies, is there is increasing concern about how much of the risk-taking activity and how much, frankly, of financial market functioning has moved outside of the highly regulated banks into the private sector. Earlier this morning, UBS Chair Colm Kelleher came out warning again that there's a bubble in private markets and that there's risks building there as an increasing amount of lending moves to that area. Are you concerned about that? Do you think that there is this sort of situation forming on the heels of rate hikes, on the heels of the more tightly regulated banks, that deserves greater scrutiny?
Absolutely. I think this notion that all we need to do to fix the problems that we saw in March of 2020 in the banking system is to pile a lot higher capital requirements on the largest banks, I think that's misguided. You increase the capital requirements on the biggest banks, you're just going to push activity out into the non-regulated banking sector, and that's going to make the financial system less secure, more unstable than the current regime. So I think we need to think really hard about what were the problems in March 2020 and how to address them.
Bill, thanks for catching up with us. Give us your view on that. Bill Dudley there, the former New York Fed president. We were talking about this in a commercial break. I remember that paper that Andy Haldane over at the Bank of England years ago, Tom, put out on this. That perhaps, and this is why a lot of people are very, very suspicious of government moves in this area. I remember Andy talking about if you banned cash, what you could do is you have money on deposit at banks and you can have deeply negative interest rates that force people to spend their savings. That's just one example of why people are deeply suspicious, TK, about moving in this direction.
Rogoff's compromise on that is to always have modest amounts of cash efficacy within the system. He does not want to eliminate cash from the system. Sweden's the most out front on this, but and this is Benoit Cœuré's leadership at Bank of International Settlements. What's really this about is they want to rip out the criminality threats and secrecy threats of the modern system. You're not going to have that with the United States doing cross-border Fed transactions with the Bank of Sweden.
Yeah, it's also who do you want to basically set the parameters for your ability to use cash, right? And right now it's banks, it's the private markets, and then people feel like they can choose what they want versus the U.S. government. But otherwise, how much of transactions at this point are in cash? Actual hard cash. It's de minimis.
Yeah, I mean, what I would say, John, is I haven't seen this. Maybe Greifeld knows. Katie Greifeld knows this. What does Bitcoin do? The price of $37,000.
That's a separate conversation.
If
to Lisa's
you
point,
have
you mentioned
Bill Dudley's
Sweden.
world.
Sweden largely being a cashless society. I think the numbers dropped below about 10% of the population using cash. But to Tom's point, Lisa, it's about having the cash option. I don't use cash, but I want that cash option. Because, Tom, what you said is a double-edged sword. Can you clamp down on criminal activities? Without a doubt, of course, that kind of makes sense. That's intuitive. But what happens next? What happens next after that?
Well,
Don't you think you outsource government control in a way that we've never seen before? And you saw what happened in the pandemic, the control that government took over our
They'll
lives.
have to have the brakes,
What do you think that looks like down the line?
That's
Let's take the climate
worry out
issue.
there.
Take the climate issue on the left. Are we going to get to a point where they turn around and say, Tom, we've been looking at your bank account. You've traveled too much this year.
I think that's not really part of the Dudley debate. The Dudley debate is, are we going to get something more efficient than present cash transactions? My answer is, what's so bad with the present system? But people smarter than me are saying we can get to a more friction-free system within governments, not outside worrying about whether Bramwell's using the Gulf Stream.
I'm going to steal a phrase from someone else, but I think a healthy dose of intellectual insubordination is a good thing in this conversation. okay? Cameron Dawson of New Edge Wealth up next. Your equity market negative 0.2% on the S&P. From New York, this is Bloomberg.
We're going to have recession, and we're going to stay with somewhat high inflation because of all the rebuilding that we're doing.
We're going to see a slowdown of the U.S. economy. We're not convinced that that has to be a recession.
The trend is very clear. The Fed is getting what they want. They want a slowdown.
When everybody is really, really pessimistic, that's usually a fantastic time to buy.
I think we'll be at new record highs for the S&P 500 early next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. Is not a snooze fest on a Tuesday. We set up for important housing data. John mentions claims here on Thursday, and it's markets churning. And just, I got a VIX of 12.87, John. We're just struggling with where are we the rest of the month.
It's snoozy, but we've got some records to talk about, and we've been talking about it all morning. Record travel in America, the busiest day in history for US airports on Sunday, according to the TSA. 1, Black Friday shopping online. Boom, record.
Boom.
2, 3, Cyber Monday expected to be another record. So going into jobless claims at 209,000, thinking about a slowdown, cause of recession and rate cuts in 2024. The data, Tom, right now isn't there yet.
And you said Standard Charter is modeling out we need to get to 4.5% unemployment rate to actually wake up and do something. And the answer is, how distant is that? I would suggest it's quite distant.
These are all guesses. I think it's too difficult to sit here with a crystal ball and say, yeah, this is when the Fed's going to cut. June meeting next year, get ready. I think it's much more instructive to work out what would lead them to cut interest rates. What are the thresholds? Standard Chartered saying, Tom, one part of that is unemployment at 4.5%. The other piece of it is core PCE at 3%. Is that the threshold to get this Fed to cut rates?
And Lisa, Barry Reynolds out with a nice summary of the Bloomberg work today of incomes are up 20%, expenses are up 18, 19%, whatever it is, cumulative. But I think it's wildly skewed. I think it's difficult math given the haves and the have-nots in America. The divide is substantial right now.
The squaring of what people are doing and what they're saying, how they feel, right? I mean, basically, they're continuing to spend, and yet they don't feel good. And so at what point does that kind of come together? Do we see some sort of meeting of the minds in between? That's what I'm struggling with. Is this an issue of just the story of two halves and where people are shaking out? Or is it that people feel bad, but they're still shopping? They feel bad, so they're still traveling. They feel bad, but they're still doing everything because they have the money in their paycheck, in their bank accounts. I don't know the answer.
That's the good news. Here's the bad news. I'll give you that number again, shall I? $119.27, Tom. That's what it requires you now to buy the same goods and services a family could afford with $100 before the pandemic. That's the cumulative inflation. That's the story. That's what's underpinning this dissatisfaction with this economy across this country.
It's there, but I'm still going to go to the have boom. I mean, somebody was talking about Florida and Jeff Bezos is moving down there, Amazon's. But John, can you imagine, what it would be for us to buy into, a rental or actually ownership at Port St. Lucie where the Mets have spring training? I mean, think about the boom economy. The boom economy in Florida, that's the haves right now, including spring training with the New York Mets.
Warmer weather and lower taxes. Is that the trade?
No, flip it around.
Oh.
Lower taxes.
Okay.
If it was in Nome, Alaska with those taxes, it'd be a boom.
I raised that question, TK, because I think this has nothing to do with the baseball for you, does it?
No, it has nothing to do with the baseball for me at all. But I'm sorry. I think it's a really interesting time, even though we're talking about Snooze Fest Tuesday.
It is, and you go through the price action this morning, and I get it, Tom. It feels a bit snoozy. Equities down by 0.2% on the S&P. Yields aren't doing much. Up a couple of basis points, up 3 to 441.37. So frame where we've been. Talk about the journey this month. Let's talk about the journey.
That's a choiceful journey.
We're talking potentially about double-digit gains, percentage point gains, month to date for the NASDAQ 100. We've seen a bond market go through 5% and back down through 440. I get it that maybe you don't see some big moves on a screen, but over the last month, we've had some major moves.
Lisa, quickly, I would submit you can't develop an internal personal conviction unless you're thinking in quiet times. You can't do that when things are nuts. You got to think about where you're heading on Tuesdays like this.
So is this a quiet time or is this a pause?
Screen's telling me, okay, I'll go with that. But the screen's telling me it's quiet. John, to salvage the data, check 12.88 on the VIX.
Low vol.
Yeah.
Yeah, that's the story.
Is that your day? Did you do the
I
data
did it
check?
already. I can do it again.
Do it again. Yeah.
You fell asleep, didn't you?
No, I didn't fall asleep. It's just a mini data check. I need a more Ferro data check.
You want some depth?
I want some depth to the data check.
Okay,
we
2 days of gains on the S&P going into Monday. We snapped that. Just a small day of declines. We're down again today by 0.2%. Coming into Monday, coming into this week, Tom, 4 weeks of gains on the S&P 500 on a weekly basis. The longest weekly winning streak going back to June. Let's see if we snap that this week. Outside of that, into the bond market, 441.18 on a US 10-year, Tom. The 10-year, just 2 or 3 basis points higher. Think about where we've been, TK. North of 5% only a couple of months ago on a 10-year. 525, 526, the cycle high on 2s. Your 2-year this morning up 3 to 488.
Nowhere else in the world a data check like that. Cameron Dawson tear-eyed over the quality of that data check. CIO of New Edge Wealth joining us right now. What's your conviction to next year? I'm talking about you need to get conviction now. Do you have a lot of conviction?
I think that we have to judge as we go into the end of the year, when we look at where we end the year with positioning and sentiment and valuations and earnings expectations. Because if we get to a point where those things are stretched, where people have been drawn into the market, everybody chases the market into a rally into the year end, that's when you probably want to start asking questions of how sustainable or durable is. We learned that lesson really powerfully this year in the opposite direction. People were underweight, valuations had come in, positioning was very light. And that set up for a very powerful year this year.
One really difficult thing for a lot of people is to get 2 things right. 1, the call on the economy, and 2, what the economy means for financial markets. I was looking at Deutsche Bank's call yesterday. Lisa and I were going back and forth on this. They've got recession, 175 basis points of cuts. Then Binky Chada's saying 5,100 on the S&P.
Yeah.
Is good news bad news, or is bad news good news? What is it?
I mean, it's sort of that I want it all and I want it now kind of mentality, which is that I want a Fed that's supportive and I want an economy and earnings that are going to be growing very strongly. And I have to think that we need to ask the question of if a strong economy and strong earnings are consistent with having Fed rate cuts and a recession. And if we can have both at the same time, meaning that if the Fed is cutting rates, can we really grow earnings at 12% next year? Do we actually have the potential that we could have a 3rd year in a row of earnings being closer to flat if we have a recession?
Well, this is John Solfis basically saying people think we're late cycle, we're actually mid-cycle, that if the Fed cuts rates, it's just sort of a mechanical year over year trying to adapt restrictiveness to inflation, and that will pave the way for companies to continue to evolve, particularly in the consumer cyclicals. Thoughts?
Yeah, it's interesting. You go back to the times when the Fed cut rates and we didn't have a recession, 95, 98, and 2019. What's interesting is that the Fed was actually very fearful of a recession in each of those times. They talked about the U.S. not being an island. What's interesting is that the market wasn't scared of a recession. There was no impact to earnings. You had the market hitting all-time highs as they were cutting rates. So I think we have to take the cue from the market. If it starts to sniff out that data is weakening, that data is starting to come in where we need to be cutting earnings estimates, we don't hit all-time highs in markets, that's when you'd say maybe recession risk is actually higher.
So what's your conviction? Is it to basically shift away from the conviction of everybody else that equities are going to go higher and to take the other side?
I think it's incredibly important to remain invested even in times of uncertainty. And the way that we do that is focusing on quality, focusing on companies that can block and tackle, which just means that I want to take out the risk that the economy is going to roll over and I'm going to have big earnings downside. But I also don't want to be over-levered. I don't want to be overextended on risk, having to have the best case scenario in order for my investments to work. So it's still that middle ground. It's worked really well this year. It likely works really well next year, as well as we think we are still in that late cycle environment.
What's so interesting to me is the idea of developing a conviction with 5% money market fund trillions out there. Is part of your optimism that that money shifts given disinflation, lower yields?
Yeah, it's a really good question if all the money market funds is truly investable capital.
But not all, but even at the margin that supports the bid.
And we do know that investors, compared to the 2022 peak, are about 3% less allocated to equities than they were at the peak in 2022, looking at the AAII data. So that would suggest that there is still money on the sidelines, that there still is positioning to be drawn back in. And the good news is that there's cash, there's liquidity in order to do that. We'll have to continue to watch that data because because once people get fully invested.
This is critical. I don't mean to interrupt, but you've nailed it. 3% is the delta here from AAI or whatever it is, AARP, whatever. But the answer is, if that money shifts and makes up that 3% difference, what does that do in S&P or Dow points?
Well, it likely means that we can continue the rally, but then it calls into question the durability of the rally. Do we test the 2022 high? Do we break through it with gusto and really have the kind of rally that we saw coming out of times like 2018, 2019? Or instead, do we have this sideways chop that looks a lot more like what we experienced in the 70s or even in the 2000s?
And that's what Chris Harvey's talking about.
Did you just request a Dow forecast?
I did.
Is that what you squeezed in?
Just busting that.
Do you have a Dow forecast?
Absolutely not. I'm sorry.
That was beautiful. Do you want to explain why you don't have a Dow forecast?
Because it's a price-weighted index.
Thank you, Cameron. TK, is that enough for
Ed
you?
Yardeni, SPX 5000's 41,000 on the Dow.
Clip that.
I mean, honestly,
put that out on social.
you guys just going to troll each other all morning.
Beautiful. And this is the perfect ending to this exchange.
It was
between
very
us.
good.
It was great.
That was very good.
Cameron, thank you. It's good to see you. Cameron Dawson of New Edge Wealth. Welcome back anytime. TK mentioned Wells Fargo, Bramo, Chris Harvey. Looking for choppiness. Didn't really get much of a call at all. Yeah. It's a trader's market in 2024.
Basically, lean against conviction. Just lean hard against it. Lean
Is that where we were 12 months ago?
I guess you could say that in some capacities. It's hard to know. It's flipped so quickly that what is the conviction on any given day? And if we do have conviction heading into next year that the equity markets are going to do really well,
we'll see. When you start to see some bad data, I'm really interested to see how this market responds to it. Claims are still at 209. The conversation we were having last week, Lisa, when it starts to turn the other way. Stuart Kaiser's been pretty definitive on this, his view, and he has a strong feeling, conviction about all of this. This is a rally built on decent data. And when that data starts to turn, particularly in the labour market, he wants to turn the other way and run really quickly.
It always looks like a soft landing. It always looks like Goldilocks until it isn't. And I keep thinking that, and yet the data keeps coming in strong every single time.
The Cameron Dawson Cam says she agrees with Bramo.
We've seen a huge divergence of economic surprises in the S&P 500. They moved higher together since the October low, and since July, economic surprises have rolled over meaningfully, and yet the S&P 500 has soared higher.
Bad news is sort of good news until...
You're killing me.
Until bad news is really bad news. Something like that.
Charles Dow said that, 1880.
Cameron, thanks again. If you're just joining us, welcome to the programme. Session lows on the S&P 500, negative here by 0.3%. Yields are higher by a couple of basis points, 440.98 on a 10-year. We'll bring you some fuller market checks throughout this morning on Bloomberg TV and Radio. Mike Mayo's coming up later, Wells Fargo on AI's impact on banking. We'll catch up with him in about 30 minutes' time. In the next hour on Bloomberg TV, coming up on the Open, Lisa Hornby of Schroders on the bond market, together with Michael Zezas of Morgan Stanley, David Bianco of DWS. Out of the three of them, they've all got interesting calls, but let me pick on Michael Zezas of Morgan Stanley. They believe inflation's going to fall much, much quicker, Lisa, than this Federal Reserve believes it will in 2024. And what we heard from Ian Lincoln of BMO there, just about 15 minutes ago on this programme, the projections in December from this Federal Reserve, I think are going to be pretty interesting. Is this a best guess from them? Or is that just a device to signal something to the market?
And how much do they lose credibility in doing that because everyone's just expecting them to try to game theory them into pricing out rate cuts so that they can actually cut rates next year because the market is more restrictive. It's mind-spinning stuff. What I think is going to be really interesting, Michael Zezas, talking about inflation might come down. That's the 2-year yield call. Yeah. What about longer-term yield and the fiscal picture and how that fits in at a time where auction sizes are getting bigger?
Tune in, Bramo.
I will.
Next hour, Bloomberg TV. I've got to run, TK. This was beautiful.
That's good. Do you want to do a data check?
Sure, yeah. Equities on the S&P 500, negative by about 0.3%. We got the Dow.
The Dow. The Dow is down 46.
46 points.
Yeah, 35,333.
What does that mean?
41,000.
It's like the weather. It's kind of cold outside.
It's kind of cold.
Okay.
Humanitarian pause has already brought a halt to the fighting, together with a surge of humanitarian assistance. Now, in order to extend the pause, Hamas has committed to releasing another 20 women and children over the next 2 days. We'd certainly like to see even that extension extended further until all the hostages are released. That's really the goal here, get all the hostages home with their families where they belong. And however long that could take.
He is not a politician, doesn't sound like a politician. Admiral Kirby, National Security Council spokesman there, on a fleet in the Eastern Mediterranean, and of course the continuing efforts we see of Israel, Hamas, and Gaza as well. Good morning, everyone. John Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on assignment right now. And Lisa, I look at where we are in the politics, and it's just fascinating in the different digital news sites how above the fold is one thing, Israel, Hamas, and there's this whole other domestic politics going on as well.
But it's deeply
under
related.
the radar.
But it's deeply related. And I will say one thing that I'm curious about, and we keep sort of hinting at, is just how divisive this issue has been, hardening different lines and how it's really split the Democratic Party in a way that has really been new and really dramatic. And I think that the consequences of that will be borne out over a longer period of time, Tom.
Well, it's going to, and the politics of the Democratic Party and the GOP, it seems to be heating up, and that's the calendar. It's almost December. The party starts in like 7 weeks. I don't know what it is in my head, January 23rd, 7-8 weeks in New Hampshire. I mean, that's the thing we're missing because we're distracted by 2 wars.
Yeah, and because people are completely unexcited about this particular election based on who the candidates are.
Right now, we're going to do this. Let's do a data check here. We'll do this for John Ferro, who was slacking off today with no data checks. Futures deteriorate -13. Dow Jones Industrial Average -49. The VIX explodes out to 12.95. Lisa, look at the bond market. What do you see besides a 7-year auction this afternoon?
I see stability, which is sort of the most interesting and noteworthy thing, considering we hadn't seen it for quite a while. It really has just been kind of range-bound, small incremental moves to the downside.
Sterling, a 126 level. Right now on our politics, Wendy Schiller joins us, exquisite at Brown University. Her textbook is definitive, framing and teaching, beating freshmen to death as she does at Brown. Professor Schiller, thank you for joining us. Percolating overnight was the former president boldly saying he would get rid of Obamacare. There was a thundering quiet among Republican senators who said, "Oh, really? Once a law becomes a law, how hard is it to change it?"
Well, Tom, that's a great question. And if you know, I know you do, you know your history. In the 1960s, after Medicare in particular, Medicaid and Medicare passed in the mid-1960s, there was a fairly significant effort to repeal or undermine Medicare, the health insurance program for people over the age of 65. And that failed after about 10 years. Because people get used to the benefit. Same thing with the New Deal. Same thing with Social Security. Conservatives, Democrats and Republicans tried to get rid of it for a very long time. People get used to the idea of a program with benefits that are available to them. And once it's entrenched and affects the job market, in particular in the economy, the way Obamacare does, giving people the opportunity to take different kinds of jobs and have more mobility because their health insurance is not necessarily tied to their job, that is very difficult to shake once people get used to it. And that's about a 6 to 10 year window, which we've now passed when it comes to Obamacare.
We're going to be doing a lot of he said, heading into the next 12 months, heading into election season. There's going to be a big focus on how the parties have changed. And Wendy, I would love your perspective on how much the Israel-Hamas war has shifted the discussion in the Democratic Party in terms of enthusiasm of younger voters, and just how big the schism is on the more sort of progressive wing versus the bulk of the party.
Well, when we look at younger voters and Democrats, we also have to remember that the bases have shifted. Democrats used to be the party of what we call the working class and people who didn't necessarily go to college. And the Republicans were the party of people who go to college. That's flipped. Now the majority of people who have college degrees or some college actually identify as Democrats, and the reverse is true for Republicans. That means the activity on college campuses has a disproportionate effect on the Democratic Party, given that those people either vote for the Democrats or they will when they get out of college. So that's what hurts the Democrats. But on the other hand, 48% of registered people under the age of 30 vote across the whole country, across all educational levels. And 72% of people over the age of 65 vote. I always repeat these statistics because it's very important to think about the actual impact, state by state, of young people on the electoral outcome for Biden and for theoretically either Trump, Haley, or DeSantis.
But Wendy, a lot of recent polls have come out and shown that more than half of Democrats think that there should be a ceasefire and have kind of pushed back against some of the president's perspectives on this. You're saying that you don't think it's going to really weigh into the election that significantly?
I'm thinking, it's November of 2023. We've seen a couple of days of ceasefire so that there can be hostage and prisoner exchanges. The Biden administration has been very supportive of that ceasefire and trying to get those hostages out. If they can get most of those hostages out and they can persuade Israel and Hamas and other terrorist groups that are working with Hamas in Gaza to sort of tone it down, we'll see if that happens. If they can minimize some of these civilian casualties that have been extraordinarily high in Gaza, if they can manage to do that, 8-9 months from now, do we really think this will be the most paramount issue for the voters that matter in this election, which is to say the voters who are sure they are going to get out the door and vote?
Wendy, I'm curious from your perspective, especially because you do work with younger people who are politically interested and politically active. I'm curious about the role of social media in fostering a lot of the views and propagating certain ideas. What's your sense of how significant a role that is in terms of shaping the dynamic in the younger cohort of the Democratic Party in particular?
I definitely think that people of my generation, even the generation before, underestimate the impact of social media and the self-selection that young people engage in when they are exposed to information. And we also don't teach enough plain history. I mean, I know that there's been a lot of exclusion of history of a lot of marginalized groups, and that has to be remedied. But there's history. There's world conflict and history, and we don't teach enough of it. So by the time these students are getting to college, particularly my colleges, the elite colleges, they don't necessarily have the same view of the world that we do and that policymakers have. So there's an increasing disconnect between what they know and what they experience and what older generations have known and experienced. And part of that is the distortion of history, frankly, from a lack of knowledge of history.
Wendy, your gateways to democracy is definitive. We used to have Western Civ 101 or Civics 101, and now we have Wendy Schiller 101. I need you to comment on the 60th anniversary of an assassination. It seems ancient. It was a different time of democracy. What are the lessons we can take away 60 years on from the assassination of President Kennedy?
I mean, we are, one thing you want to think about is that we have been a violent nation with gun violence against our leaders for a very, very long time, right? Abraham Lincoln, McKinley, among others. I mean, obviously Bobby Kennedy, not in office, but John F. Kennedy. So what we want to say is that we're shocked by gun violence, but we've lived with gun violence, particularly at the highest levels, for a very long time. And the second thing is who is in the Oval Office matters. John F. Kennedy would have taken a different route, one expects, in terms of civil rights, in terms of social health care policy. A lot of the things that Johnson got passed were not necessarily on Kennedy's agenda. There's no good or bad with that, obviously. It's just a fact that when you have a different person in office, policy changes. And the trajectory of American social welfare policy changed considerably because Johnson was in, not Kennedy. And that's what I think about when I think about the sort of difference between Biden and Trump, particularly for young people going forward, thinking about what that will mean on the trajectory of your entire infrastructure of social welfare policy.
Definitive. Wendy Schiller of Brown University, thank you so much. Lisa, my study of this is, and this has been said by many far more qualified than me, all of the centrist and left legislation of the 60s was passed off the shock of the assassination. It's not about 63, 64, 65, pre-Vietnam, 66, dare I say. So much of that legislation was put through with Democrats and select Republicans because of the assassination.
And how much going forward will the definitive features of the next 10 years be the pandemic, the wars that we've been experiencing, and some of the other key features of the past couple of years?
We'll continue forward on economics, finance, investment, and our American international relations futures in -9. Coming up next from Chicago, Carl Tannenbaum, always of interest at the Northern Trust Company. From New York, this is Bloomberg Surveillance. Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on deep assignment into the 9 o'clock hour. We'll see how that goes. He has David Bianco, which is going to be very interesting. I'm really interested about what David Bianco says about 60-40.
Very much so. I'm also interested with Michael Zezas, the policy prescription going forward, given the uncertainty of government shutdown, debt issuance, how much of a fiscal impulse is going to have to roll over heading into 2024.
A really interesting appointment for Morgan Stanley with his years inside the Beltway doing policy for Morgan Stanley as well. Right now we've got research notes coming in. It's what we do. We bring you the research notes, and thank you to all. We protect their copyright. Go to Toronto to get David Rosenberg's love note on disinflation. And this morning, David Rosenberg doesn't mince any words. He says, Tom, straighten out your bow tie. I'm doing that for radio right now. And also, David Rosenberg says, add duration. He doesn't mince any words like Ian Lingen. He says, yields lower.
Well, to me, this is really the reason why I'm actually pretty focused on the housing market right now, and I know that you are as well. And we get some housing data at 9 a.m. here in terms of house prices. But yesterday, I really want to sit on this for a minute because it was the focus of a lot of debate among a whole host of market prognosticators that you saw new home sales, the median price, fall 18% year over year for the month of October.
And that's through the level of 2008.
Which raises, right, so then this raises this question, does this indicate a significant decline in home prices ahead? Or is this home builders that have overbuilt, that are dealing with higher mortgage rates, that are having to cut prices to move inventory that doesn't necessarily bleed through to existing home sales?
And what's interesting about this, and it goes to Andrew Hollenhorst's call at Citigroup, which is a shift from a higher rate regime to at least stasis, if not in like Rosenberg or Ed Hyman, and how opposed that is to what we heard from Katie Kaminsky this morning, who is looking for a higher yield regime. I would suggest maybe Katie's a little bit lonely.
But this, to me, is one of the big questions, and we got a note out from Andrew Hollenhorst, who is actually with her, with the risk of potential really reaccelerating inflation, talking about how this could be a head fake with home prices and how it really does hinge on that for them, too, because this goes to rents, this goes to perceived costs, this goes to sentiment that we've been talking about all morning, and how the cumulative effect has been massive when you take a look at home prices and rents.
Stay with us on radio and television. Carl Tannenbaum to join us here in a moment from the Northern Trust Company. But first, a brief from Bloomberg Intelligence's Jeffrey Langbaum on he's senior REITs analyst, but just on real estate as well. Jeff, I got to cut to the chase. The emotion, as Lisa mentions, of negative 18% year over year in housing. How in disarray is your study of American real estate?
So thanks for having me, guys. On the housing side, it's interesting. Obviously, you know, with mortgage rates where they are and nothing for sale, it's not surprising that home prices have stayed elevated. And what's interesting is that the demand is really shifting to the rental side. And so, you know, the apartment REITs that I cover, the demand is still there. They're facing some new supply issue in certain markets, but the rents are holding up. And for the most part, commercial real estate has some trouble spots, but residential real estate is doing really just fine.
But Jeff, this really raises a question for the next phase of this economic cycle. Do we start to see a plateauing, at least, in valuations, which we have seen around the edges, or do we see significant price declines in houses as rates come down, as people start to actually sell, we get inventory, and that will lead to an even greater disinflation that people are expecting to see next year?
I mean, that could happen. What's hard to predict, though, is the mentality of those that own homes and when or if they sell, depending on where rates go. But yes, if rates do move to a level where home owners are willing to sell, prices are going to fall as inventory rises. But I don't know that. I think the biggest issue for disinflation on the housing side is the significant change that has happened on the rent growth side, right? In 2022, rents grew. 2021 and 22, rents grew on average 20-something% aggregate, and that's now basically fallen to zero. But it's not showing up in the inflation numbers that way yet. And so I think that there is a slowdown coming. I think that what happens in the for sale housing markets and in valuations broadly, it's too early to say, because if rates stay where they are, I'm not sure that there's too much of a change in the inventory.
So do you think that this is going to be a significant driver of the story next year, of what happens in rents, whether they continue to sort of plateau and that starts to work its way into the data?
Well, so they've plateaued, and now I think we're into a more normalized rental growth environment. If home sales stay stagnant and it's impossible for to buy homes, rent demand, can theoretically keep up with the new supply that's coming, and can get rents growing at a normalized inflationary rate. But it really comes down to rates, and because if rates do fall and homes start to move and home prices fall, then renters all of a sudden have another option.
Jeff, thank you so much. Jeffrey Langbaum with us with Bloomberg Intelligence on real estate. We'll talk to him about the office challenges here at another time. This is a joy. Carl Tannenbaum with his literally public service with the National Association for Business Economics. He's chief economist at Northern Trust, and weaned completely at the People's Republic of University of Chicago over the years, which means what is macroeconomics? It's simply more microeconomics. And he joins us right now. Let's talk price theory of Chicago right now. Are we done the supply shock of the pandemic?
Well, as a graduate of the University of Chicago, I am obligated to begin my response by saying that the money supply is the only thing that matters for inflation. It is falling for the first time in at least 60 years. I think the relationship between money and inflation, Tom, had been fraying even before the pandemic, but like many of the identities that we used to use pre-COVID, I think that relationship has changed a great deal. Bank reserve levels are very different. The Fed's balance sheet is very different. So it's very hard to make that translation. It's one of the reasons why I think the Fed remains cautious. I think it's very hard for them to look forward 6-9 months and feel confident that inflation is going to be at their targeted level. And that's why they have continued not only to stay conservative, but sound conservative. And in their dot plot and in their SEPs that we'll get later on in December, I'll not only look at their median forecast for inflation, but what they see the risks are around inflation. It's at the back of the pack, and people don't look at it, but the risks to them are still on the upside.
We're going to do this here. We're going to rip it up. When you go M2 with Carl Tannenbaum, you got to rip up the script. We're going to do this right now. Goolsbee of Chicago is positioned as a dove. If we get disinflation, is that dovish, or does that provide a hawkish tendency of we lose stability?
We have disinflation now. We need a little bit more. I mean, most of the major price indices are hovering just below 4% on a core basis. If you look at the last 3 months, it's actually getting closer and closer to the target. But it's always going to be the last few yards that are the most difficult. We talked about real estate in the previous segment. We have seen that come down only very slowly. Everybody's been expecting that to roll over, and it's coming down very slowly. I think the dynamic of the housing market is one that is still very confusing to the Fed. And we still have core services that are rising in price at about a 4% pace. The labor market is maybe a little bit looser, Tom, than it was 6 months ago, but it is still very robust, and people are getting higher wages.
You said that housing is very confusing for the Fed. It's confusing for everyone. It's exactly counter to what everyone thought would happen when mortgage rates go to 8%. How important is that to the next phase of whatever happens, to next year's disinflation?
It's critical. The housing component is about 40% of core CPI, about 30% of core PCE. So without a much lower rate of inflation in that category, you're not going to have the Fed's target achieved durably. If you break it down, we have goods inflation that's basically 0 right now. You have core services at 4, and you've got the housing at 4. So if you can get that component down to 2, but what that's going to require is a much, much slower job market, because that's one of the biggest supports for housing of all kinds.
How much do you understand what we were talking about yesterday with new home sale prices, the median prices coming down 18% year over year for the month of October, at a time where that really was the only market open, was the new home sales built by developers? Is this a specific market story having to do with the home builders overbuilding and facing off with higher rates, or does this indicate greater price deflation going forward?
In spots, certainly, you're seeing some of that dynamic. The housing market, obviously, is a very regional market, and so it's hard to decompose. And as you know, I think existing home sales are many times the new home sales. But to your point, the turnover of existing homes has been slow. But I think even with that, about 5% of homeowners move every year. It's down from the normal level, which I think is about 8%. But as they do, they're going to be trading out of that 3.5% market into, perhaps a 7 or 7.5% market. And that's one of the many things I think that is increasing the impact of Fed policy. The lags are long, but they're not infinite.
There we go. There's a Chicago language. Jason Furman of Harvard out with a terrific tweet moments ago. And Lisa, this goes to the heart of your discussion. Furman identifying 36 months, the Thanksgiving dinner was up 30% in 3 years, up 30% in 3 years. Should we look at month over month, year over year, NABE blather? Or does Carl Tannenbaum look at the effect on America back towards the pandemic? Which way do you do this?
Well, let me just say that having hosted 27 people, I felt their pain. I had to get special financing to afford
use it for
one of the
buy now, pay later.
yeah, but it did ease a little bit, but I think this is one of the reasons that economists and people feel inflation differently. The costs were down, I think it was about 4% over the prior year, but still much higher. People experience levels, especially at the supermarket, and so their perspectives on inflation, which affect confidence, are very different from those of us who follow it from an academic perspective and are looking at the changes. So I think that is a frame of reference that shapes inflation expectations, and the Fed has to pay close attention to that.
Are we too confident about a soft landing? And I mean the market.
I never had a recession in my forecast, so my track record is now 2 and 23, I think. And I'm sticking with that forecast for next year. But a lot has to go right, including the calibration of the rate decreases. We don't think the Fed is going to feel comfortable enough to cut rates until the middle of the year, so later than the market does. And that dynamic is really going to be very critical. How do you land on the head of a pin with rates exactly where they need to be to avoid the employment market getting too far off? That's going to be a difficult chore.
It's beautifully said. The idea that our economics is landing on the head of a pin. The VIX 12.86. Standard & Poor's down 0.1%.
I like how we were just talking with Carl about the mystery of a housing market and how that's so key. And the reason why I keep focusing on that is because that goes to sentiment, that goes to consumer spending. How much is that one of the features that's really underpinning the fact that people don't feel good, but they do keep spending on things like airline tickets and different types of clothing? To me, if you can't afford to move and you're in a small space and you're locked into a mortgage rate that's very low, that affects sentiment.
I would say we're looking at a holistic one America, and there's two Americas or even three Americas. There's one America that's not part of the debate. There's another one that's really fallen behind. They do not have real wage income growth. They're in the middle, maybe the upper middle, and clearly at the lower deciles and always at the upper deciles, there is a good feeling. And so how do you have the TSA with record travel, and at the same time, the food lines are substantial in some of these cities? I mean, that's really the heart of the matter.
It's been a confusing economy, and getting the economy right and then getting the market call from that right has been incredibly difficult.
Economic data here at 9 o'clock, including Case-Shiller. That will be interesting to see, to say the least. On the data front, I haven't even mentioned it this morning. The real yield, 2.17%. Shocking where some people say that real yield could add here with a disinflationary tendency well under 2%. That would be interesting. I've got to go back to oil. A new paradigm for a gallon of gas. Where will that be at the end of the year? Fascinating question. When will we refill the strategic petroleum reserves? In the equity space, futures at -7, Dow futures at -17. The VIX, it's a bull market, 12.85. Lisa Abramowicz, Tom Keene, Jonathan Ferro out there somewhere, Michael Mayo, Wells Fargo, next. Good morning.
About 45 minutes until the U.S. Open. A little action, a little drama. I do want to bring to you some news just crossing. This, according to the Israel Defense Forces, coming out and saying that 3 explosive devices were detonated adjacent to Israeli troops in 2 different locations. This violates the ceasefire agreement. We will update you on what we find out going forward. They say that some soldiers were injured and that this does violate the terms.
The adverb slips in lightly injured. This is Alyssa Ottenheimer summarizing this for Bloomberg. This story is hugely moving right now, but Lisa, what we can say is certainly, as there always is in ceasefires, there just always are violations at some level.
We'll keep you updated as we find out, but we've been talking about the calm that has been so welcome for so many people when it comes to the situation, the war between Hamas and Israel, and whether this changes that scenario. We will find out, and we will bring to you the latest.
We'll have that for you and look to Balance of Power and Sound On tonight on radio and television for that as well. Futures at -8. Lisa, this is Joy. Why don't you bring in Mr. Mayo here? Because he's all AI and bankings.
Which makes me very happy, actually, because Thanksgiving dinners, several of them, all of the discussion was about artificial intelligence. Mike Mayo focused on artificial intelligence as well, saying that it's not just going to be in big tech, it's also going to be in banks, that you need to have AI talent at the financial institution, saying the marriage of banks with tech, including AI, is a long-term positive that can help the industry trend toward record efficiency. Joining us now is the one and only Michael Mayo. Mike, thank you so much for being with us. So tell us just how much banks could benefit at a time where people have written them off as utilities that are overspending and are not going to make big returns.
Well, if you're a bank and don't have an AI strategy, then you don't have a strategy. Because if the bank across the street has calculators or spreadsheets or Bloomberg terminals, and you don't have those, then how are you going to compete? So AI is here to stay. The marriage of banks and tech has been a good one. It stalled recently, but I think AI can rekindle that relationship by taking the productivity benefits, which have been revenues per employee have improved by 1/3 over the last decade. So banks and tech have been working, but I think AI can take that to another level.
Is it a kind of thing where there'll be a few winners? You mentioned Goliath, Mike Mayo, in your note. Is it a kind of thing where 4 or 5 will win and the rest lose, or can it actually be a benefit distributed across the industry?
Well, I think most jobs at banks will be impacted. I mean, think of what I do. I'm an analyst. And analysis can be improved by this extra tool called AI. Now, I do think there will always be a human in the loop for most cases. In other words, to prepare for your show today, Lisa and Tom, I went to ChatGPT and said, what should I say in one sentence about this? And they said, it's a revolution that will enable productivity savings and better customer service. Well, that's an that's an improved starting point, but it's partly wrong. First of all, I'm not sure it's a revolution. Especially at banks, it tends to be more of an evolution. And simply by enabling that potential doesn't mean that becomes a reality. And you've seen false starts. Cloud, you've had some buyer's remorse. Blockchain didn't come out as quickly as expected. The dot-com bubble 1.0, Tom, you remember all these internet banks which didn't survive. So I'm positive on the implications of AI, but I'm aware of the caveats.
Let's go back even further. George Ball, E.F. Hutton, they blew it. They couldn't keep up on technology. This is, Lisa, when there were cards with holes in them and a thing called Fortran. The answer is, I want to know who the losers are going to be in this. I mean, I know you got single best buys and all this, but what is the scale of the losers that you see in technology and banking 3 to 5 years out?
Well, I do think Goliath is winning, and you have this poll by Evident. I know you've had the founders on your show. In fact, they have an all-day conference in New York City tomorrow. So JP Morgan is #1 front and center right now, and their investments in technology are paying off. I'm surprised to see Citigroup in the top 10 for all their issues with their back office, and they have major issues. They're making some efforts with AI. On the other hand, those banks that have not advanced with digitization and the cloud and getting their data together could struggle. And I do wonder about some of these mid-sized banks. I mean, do they have the scale to really leverage these solutions? And getting talent. Talent is such a big issue.
That's where I wanted to go.
And you can't just buy talent off the shelf. You can get solutions, but who's actually going to implement those solutions in each business line.
So when I'm listening to you, I'm thinking, how much are they going to pay them? I mean, we're talking about OpenAI paying $800,000 to engineers at just sort of base level. I mean, how much are banks going to have to pay some of this talent to come to their bank and develop similar solutions that can effectively support and reduce certain headcount in certain areas?
Well, I think what you'll see is a reduction in headcount and some of those savings plowed back into paying other employees more money, especially AI engineers. They're in serious demand. But if you go to one of the largest banks, you have a whole career path. You can scale these solutions across tens of millions of customers as opposed to going to a smaller bank. I mean, what's your pitch? Now, there are some smaller banks in this evidence survey that performed quite well because they were already ahead on technology. So I think those winning in technology can keep winning more, and those that are behind are going to have kind of a existential moment here.
This can all work if banks have the cash to invest, right? And that sort of, you put a pause on that at a time when potentially there could be a slowdown and there could be some kind of reduction in revenues tied to slowing capital markets. How much, I understand this is a longer term call, but how much do you see a thawing in that kind of environment next year versus a tightening of the screws? I mean, this is sort of one of the big disagreements for the backdrop for banks and capital markets activity at a time where yields are still high, but we also are potentially going to start seeing the effects of that.
Well, I promise you I will be the first analyst to ask that question on earnings calls if banks are spending too much money. Banks have no choice because of the headwinds from rates, recession possibility, and regulation. They must get more efficient. So if I'm the CEO of any bank and you're coming to me with the program for AI and want to invest a lot of money, I'd say, great, where are you saving the money to fund that?
Nobody cares. All we want to know from Mike Mayo is what to do this year 12 months out. 12 months ago, NASDAQ flat on its back. We've had a magnificent 7 moonshot. Right now, Keefe Bruyette Index is 25% above the pandemic low. Is this the year 2024 of the banks? Do you load the boat here on banking?
Well, look, the long arc of the benefits of the industry de-risking has still yet to play out. Banks didn't get credit through the pandemic. The excuse was the government stimulus.
Right.
Right now, you had some smaller regional banks fail earlier this year. So it's still delayed. So I still think over the next 2 to 3 years, you see the benefit of the improved banking industry resiliency play out, and then they aren't as risky as perceived, and they re-rate at least back to historical. And then the bigger question is longer term, do they re-rate above? Now, it's not immediate, Tom. I think as you get further out, you get better inflection points when it comes to bank spread revenues, interest rates effects, monetizing that capital markets backlog, and more clarity on regulation, which is a very big issue still.
Just real quick, just to follow up on the AI, what is the right AI investment? Is it getting some sort of application to write your reports for you? Is it being able to collate data from your customers to basically prescribe what they're going to do or want? What's the correct way?
There's no one-size-fits-all when it comes to AI investments. It's about banks tailoring those AI investments to their use cases that they have that's unique to them. So I find interesting anything related to compliance, fraud, cyber. That's where you're seeing some really low-hanging fruit, early benefits. I think when it comes to some additional automation in the back office, I love what it can do for technology. The idea of COBOL program changed to Python, change to C++, the ability to change archaic code. And by the way, most or almost all large banks still are advertising for COBOL programmers. Tom, come on.
You're killing me.
By the way, my first programming class had punch cards too. So
yeah, well, we're that ancient. Lisa's like, what are they talking about? Single Best Buy, 10 seconds.
JP Morgan and Citigroup. I had said.
Okay.
Barbell approach.
Barbell approach. Mike Mayo, thank you so much with Wells Fargo on AI and something there. All I want is Zelle going to get better? We need to get to serious headlines here. These are a movable story. Certainly, our Alyssa Udenheimer reporting for Bloomberg First Word on a framework of operational pause violated. That is the news of injury. This reported from the Israeli Defense Forces.
Yeah, and just to be clear, there is no indication that the truce is not intact anymore. It still does appear to be intact. But the Israeli army coming out and saying that the truce terms were violated due to an explosive device detonated in northern Gaza that did injure several soldiers.
Much more on that through the morning. Please stay with us. We'll have that for you on radio and television. Futures at -9, the VIX 12.88. An interesting day. Case Schiller at 9 a.m. Good morning.